Right, good morning to everybody. And Dan, thank you very much for that lovely music you played. And as the word said, we want you all to be happier. And welcome back to day 2 of the BCI Global Investment Conference. We again have a fantastic lineup of some of the top local and global fund managers for you. Active versus passive, local or onshore, long or short duration. What about credit? How much of the recovery was front loaded over the past 6 months? Global inflation, talked about a lot yesterday. Or if I might quote Tony Bell from yesterday, is it rather about how global growth will evolve? Some sobering thoughts there. These are all the questions you and I have with our clients on a day-to-day basis. The BCI Global Investment Conference is not just a lineup of presentations to earn CPD points, which you will get. We purposefully arrange all the topics to best address your and your clients' everyday concerns, looking for solutions by engaging with some of the top global asset managers you will see. And we encourage you as our audience to engage with the presenters via the Q&A box right about here at the bottom. Throughout the conversation, please post your questions. We will address those questions in the main conference room as best we can. If we can't get to all the questions, we will deal with them in the breakaway sessions as well. On the topic of CPD, many thanks to Tanya and the team for the 11.5 provisional CPD credits. We know the FBI must still approve this, but thank you so much, Tanya and your team. Done great work so far. And no, this can't roll over to the next cycle. So best you attend next year's conference at Spear. Yes, we've got to have it at Spear, where we can all meet again face to face, huddled in the cold with a warm cup of coffee and share some great ideas and stories. Right. Joining us now and here to moderate and introduce our first panel of the day on SA multi-asset low equity is Tavonga Shavize, Chief Investment Officer at Boutique Investment Partners. Tavonga, good morning. Great to have you with us. If I may add very quickly, Boutique Investment Partners is an independent investment management and consulting firm that specializes in the provision of global focused multi-management, investment management, and consulting services to both Cat 1 and Cat 2 intermediaries. Dave, thank you so much. The floor is yours, and you can introduce your panel, which we anxiously wait to see. Thank you so much.
Thank you, Eugene. Good morning, everybody. I'm going to start off by reflecting on yesterday. I think one of the key areas of agreement from our speakers was that for various factors, such as excessive levels of debt to GDP, changing demographic profiles, and definitely shifting monetary policy frameworks, we are potentially now in an environment where interest rates will remain quite low for a considerable period of time. Now, add another key area of agreement yesterday, that of rising inflation concerns. All of a sudden, you're in an environment where the real yield potential of your lower risk asset classes, where capital preservation is relatively easier, has become very, very elusive. Ideally suggesting that if you're running a mandate which wants to maximize real yields, you have to be comfortable increasing exposure to asset classes where capital preservation is relatively more difficult and far more complex. Now, today we're starting off with mandates which are which have been given targets which literally work in contrast to this environment, where they need to maximize real yield potential, but also maximize capital preservation. How to do that when much of the real yield in asset classes where capital preservation is very difficult is a conundrum, and is a conundrum which I hope our first two speakers are going to address. I have Alan Gray from, I have Sean Monsey from Alan Gray, who is going to tackle this by looking at the various asset classes where higher real yield potential exists and the various strategies they'll employ to maximize capital preservation. I also have Anthony Bradford from Fairtree, who is going to tackle this conundrum from a behavioral finance perspective, which I think is going to be quite an interesting one, I think, for all of us to engage. I'll start off by handing you over to Sean Monsey, after which our Philip Anthony Bradford will come in immediately. And should we have time after their presentations, we'll open up for a few questions. Over to you, Sean.
Thank you very much, Tavonga. Would you be able to bring up my slides for me? Thanks, Dan. So yeah, thanks for the opportunity to present to you today. I'm a portfolio manager on the Allan Gray Stable Fund. I think this conference comes at an opportune moment with advisor investors perhaps reassessing their portfolios after navigating the 2020 investment rollercoaster and the welcome bounce we have seen in financial markets since the start of the year. I plan on talking through the opportunity set currently available within the multi-asset low equity space, and hopefully leave you with some insights in how we look to balance the risks and rewards offered by the asset classes at our disposal, both locally and offshore. If we could just skip 2 slides ahead, please. Thanks. We continue to be of the view that some allocation to equities is appropriate in order to sustainably generate long-term real returns, even for more risk-averse investors. This chart shows that a theoretical low equity strategy invested in equal parts local cash, bonds, and equities would have generated an average 10-year real return of just over 3% annualized. I think there are 2 important things to note on this chart. Firstly, 10-year equity returns rarely go negative, only twice or 3 times over the last 100 years. And when they do, they are typically followed by a sharp upward bounce. In comparison, bond 10-year returns have gone negative more often and for prolonged periods, primarily owing to the lack of inflation protection that nominal bonds offer. So much so that this can drag the overall fund return into negative territory. Absent an allocation to equities, drawdowns would have been far steeper still. Next slide, please. Shown in another manner, you can see that equities have comfortably outperformed bonds and cash over most time periods, often by a material amount, making them a key part of any portfolio for a client with a decent investment horizon. Admittedly, this outperformance was less evident in the last half of the previous decade, when the all-share index went sideways for extended period, coinciding with a time of high cash real rates, which understandably tested investors' patience. In addition, the JSE underperformed global markets, exacerbating this frustration. Despite the recent bounce, we still think there's decent value to be found in the local market. I will talk to our current outlook for local shares later in the presentation. Next slide. An important decision to be made is the allocation between local cash and bonds. SA and US real rates began to diverge around 2013 as our fiscal metrics began to worsen. Rightfully so, there's skepticism regarding the government's ability to stick to its spending plans. But at a real yield differential of more than 5%, we think some of these fears are overdone, particularly when SA is compared to other developing countries with similar or worse indebtedness. The outcome of the government wage negotiations currently underway will be a key test in this regard. Also, we don't expect local inflation to rise materially over the medium term, helped by the Reserve Bank's conservative approach. Accordingly, we have allocated a greater percentage of fund assets to bonds at the expense of cash and have increased duration in order to take advantage of the steep yield curve and generate a decent real return for our clients. An allocation to inflation-linked and floating rate bonds offers protection if inflation goes ahead of our expectation. Despite the recent sell-off, we still think offshore bonds offer poor value. Here, we prefer hedged offshore equities. Next slide, please. Developed market central banks have shown far less restraint than our own with the size of balance sheets exploding over the last year as fiscal deficits are monetized. While this has been successful in propping up COVID-hit economies, it has also served to create potential asset bubbles in certain pockets of the stock market, property market, and cryptocurrencies, amongst others. To a large extent, this monetary stimulus is now in the base. The next big question is whether the latest inflation prints we are seeing in these developed market countries are transitory or something more permanent. Personally, I think it is too soon to tell. Next slide. What we do know is that inflation expectations have an impact on actual inflation to the extent that consumer confidence in the value of money is eroded. The structurally high inflation that South Africa saw in the 1990s and the 2000s is an example of this, which the Reserve Bank did a good job of managing down over time. Central banks play a key role by anchoring consumer expectations to low and stable inflation rates. Interestingly, this chart shows that mentions of inflation by company management surged eightfold during the most recent US reporting season. Next slide. If high inflation does come to pass over the next while, even at levels of 3 to 4% in the US, which asset classes stand to benefit? Traditionally hard assets such as commodities and property, cyclical sectors like banks and smaller cap shares, and value stocks have outperformed. This could come at the expense of the winning strategies of the last decade, namely the US market, technology, and consumer staples, as well as passive strategies. Next slide. So one way to protect against inflation is an allocation to commodities, which is particularly relevant for local investors, given the weighting of miners in our index. While inflation serves as a tailwind, there's more to the fundamental investment case for some commodity and commodity producers. One example is the decarbonization policies to reduce carbon emissions currently gaining pace around the world. As part of their rebuilding strategies, governments have set ambitious targets for renewable energy provision and electric vehicle penetration. If these goals are to be realized, this has particularly bullish implications for base metals. The additional demand for copper, nickel, cobalt, and zinc that these initiatives could create must be set against a relatively constrained supply outlook, meaning prices have to move higher in time in order to incentivize new sources of supply. This goes some way in explaining our preference for Glencore over the other diversified miners in our funds. Next slide, please. So turning to our local market. After inflation is taken into account, the all-share index is on par with where it was prior to the global financial crisis in 2008, 13 years ago. Given the underperformance, SA screens as attractive relative to both developed and emerging markets. As part of our bottom-up stock picking process, we continue to find cheap shares amongst our local banks and insurers, retailers like Woolworths, industrials such as Naspers and MultiChoice, and selected miners such as Sibanye-Stillwater and Glencore, as I previously noted. Outside of the resources sector earnings, we think earnings for the companies I mentioned are below what we would consider normal through the cycle. All are trading on attractive valuations. In deciding the allocation between local equities and bonds, cognizance must be paid both to anticipated returns on offer and balancing SA risk with offshore earnings exposure. Next slide, please. And lastly, to finish up with offshore. So lessons from history would suggest that in previous cycles, where specific sectors or markets predominated, such as the NASDAQ does now, subsequent returns were poor, be it gold in the 1970s, Japan in the 80s, .com in the late 90s, or resources in the 2000 super cycle. In some of these cases, it was decades before previous peaks were reached, if ever. The takeaway is that the price you pay now matters. Starting valuations have a material impact on prospective returns. Next slide. Here we compare the FANGM names, that is Facebook, Apple, etc., to the S&P 500. Tellingly, relative performance peaked in September 2020, with a number of these companies subsequently trending sideways. While we can argue about valuations, our main concern is not with these mega cap names, most of whom have built great sustainable businesses. Worryingly, it is the more speculative, non-profitable tech names propelling the headline indices recently. At last count, there were more than 70 companies in the S&P 500 trading at more than 10 times revenue, a rich valuation in our estimation. Next slide, please. The biggest US stocks are up 40% since the start of 2018. In comparison, the average global stock only took out its highs late last year. It is here where our partners at Orbis are finding value. Accordingly, they are underweight the US and overweight Europe and Asia. Examples of areas they view as attractive include automakers such as BMW and Honda, Asian tech names like NetEase and Taiwan Semiconductor, and select defensives such as British American Tobacco and pharmaceuticals. Next slide. So to conclude, I think the flexibility inherent in the multi-asset category provides us with the ability to invest across asset classes to where we see best value. And then an allocation to equity, if valuations justify it, and we think that they do, boosts returns through the cycle. While, as always, there's reason for caution, we construct our funds to perform well under a variety of scenarios. Looking at the three main building blocks of the fund, namely local bonds, local equities, and offshore, we still think that the outlook for real returns remains promising. Thank you for your interest in Allan Gray, and I look forward to taking your questions later in the day.
Thank you, Sean.
So good morning, everybody. Dave, thanks for the introduction. One of the curses of being born into a family with a family name that's a first name is people often confuse my name and my surname. So for those who are a bit surprised not to see Philip Bradford, now I'm not Philip Bradford from Portfolio Metrics. I'm Bradley Anthony from Fairtree, and I'm here to talk a little bit about the Select BCI Cautious Fund. But from a different angle, looking at it more from a behavioral finance perspective. Not that I'm an expert on behavioral finance, but to give you a bit of a perspective on how we think about portfolio construction. So I've entitled the presentation "Regret Maximization: Why We Hate Diversification," and obviously with hindsight. I don't know how many of you have been to a dinner with friends or with your partners, and you sit and you see the food arrive across the table, and you have a bit of food envy because you have this regret of missing out of what's across the table. I certainly have had that experience, and many of us have. So in behavioral finance, there's a theory called regret theory, which looks at this concept of anticipated regret. But just like food envy, when you throw in hindsight for investors, I've entitled ROMO, the regret of having missed out, is equally large. So let's just talk about that for a second. So in modern portfolio theory, What one does is you tend to look for uncorrelated asset classes, uncorrelated building blocks, and you construct portfolios. And this is typically reflected along an efficient frontier, as you can see on the chart over here. And what you do is you pick the spot in the efficient frontier which exhibits the highest possible risk-adjusted return. And that all makes perfect sense. And we all understand that. And when we're constructing portfolios and we think about building portfolios for clients, that's what we think about doing. But that sneaky thing of Romo tends to come into the picture with hindsight. And we tend to always have a BDI on that highest possible return. And we start to have conversations around, wouldn't it have been better not to have been in that asset class? Or wouldn't it have been better to be exposed to X or Y asset class? And we start to ask questions around, does that make sense that you only have X amount exposed to whatever that asset class may be, offshore, currency exposure, etc. So let's just unpack that for a second. The reality is that when you look at something like the correlation between the top 40 and the All-B, this is this rolling 12-month correlations of daily returns for roughly 20 years. And the one thing that's stark that you can see from this is that it's not easy to pick when to switch between different asset classes. And typically what we do is we want to switch between asset classes at the worst potential time. So that regret maximization just starts to come to bear when we start to look at correlations like this, which vary over time, and hindsight plays a perfect role in actually trying to determine where we should have been exposed. The next question is, what about the Rand? And everybody always wants to ask the question, well, how much offshore exposure do you have in your portfolio? What's the right amount of offshore exposure? And where do you think the Rand's going? And we all know that over time, typically what people do is they tend to allocate to offshore just at the wrong time. When the Rand's blown out to 19 Rand to the pound, 20 Rand to the pound, they're looking to offload their Rands and go offshore. Whereas when the Rand's at, let's call it 12 Rand to the dollar, nobody's that keen to offload because they all think, well, the Rand's strong. So this behavioral impact or this behavioral decision impacts the asset allocation decision. But let's look at the influence of the ZAR on the South African equity market. And I think it's important to look at this in the context of the portfolios that we're talking to. We're talking to multi-asset, low equity portfolios, which are essentially cautious or stable portfolios. And when you look at a long-term chart, this is a long-term chart to the USD ZAR, it's obvious that over time, the Rand depreciates. So it's obvious that over the long run, you need to be short Rand or long dollars or long some sort of hard currency. I think Keynes said it best that in the long run, we're all dead. But let's leave that for now. Over a 5-year or shorter period, for cautious portfolios, which are all about capital preservation, consistent returns, it's less obvious what the right thing to do. So we did a bit of a study, and we looked at conditional beta study. So let me just step back for a second and try to explain the chart that you're looking at. What we did was we took 20 years of daily returns in the USD ZAR and the top 40, and we bucketed those 20 years of daily returns into random buckets of equal size of observations. So there are 250 observations in each of the buckets, and you'll see those buckets on the left-hand side of the chart over here. So on this vertical axis, you'll see the buckets, and you'll see they're not uniform, so they're random. But the only thing that is uniform about them is that each bucket contains 250 observations. We then did a regression of these moves in the ZAR against what happens in the equity market in those particular periods. And you'll find that there's no uniform relationship. There's no discernible relationship. At the top of a year, this is when the Rand is depreciating. And at the bottom, this is when the Rand is appreciating. And you'll see that the beta of the market to the Rand, whether it's appreciating or depreciating, is random. There's no specific relationship over time between the two variables. The other thing which is interesting, that if you actually drill down deeper and you select one of these buckets and you try to drill down and try to understand what's happening in these buckets, and for me, that probably less quantitative than the rest, I understand something that has a beta of 1. If it has a beta of 1 it's going to look and feel and taste like whatever its dependent variable is. So if the market has a beta of 1 to the ZAR in this particular bucket, this particular sample, and the ZAR is producing a return of between minus 0.7% and minus 0.9%. So in other words, it's an appreciating rand by that to that degree on a daily basis, then you would expect the market to have a mean in its distribution or somewhere in the same region. But look at this, the mean's nowhere near that. And this has got a beta of 1. So if you look at other buckets, the distributions are equally contrary to expectations. So the reality is that we can try to develop very smart models to try to determine whether we should be exposed to the rand or not exposed to the rand, or exposed to the rand vis-a-vis the equity markets. But the reality is that the rand remains a perfect candidate for regret maximization. And so we believe that the best way to think about the rand is rather to consider the influence of the rand on the volatility of excess returns in the portfolio, which leads me to talk about excess returns for a second. So what are the alpha sources in a multi-asset portfolio? And I'll use the Select BCI Cautious Fund as an example. In any multi-asset portfolio, there are really just 3 alpha sources or excess return sources that you can derive returns from. The one is your strategic asset allocation. Now, Roger Williams yesterday in his presentation spoke about constructing an efficient frontier and building that portfolio which reflects that efficient frontier. That's really the same thing, it's just using different language. So however you determine that strategic allocation, this is the long-term allocation which you believe best or gives you the best opportunity to meet your return target within the portfolio. The second alpha source are these tactical tilts, where we're trying to look at what are the opportunities that we can expose our fund to, where are the tailwinds, where are the headwinds. And the reality is, and I'll show you in a second, that in the Cautious Fund, we actually are not overly active from a tactical point of view. Where there are particular distressed markets that we see on the horizon, we will act, but I'll talk to that in a second. And then the third alpha source is really your security selection. So let's drill into that for a second. So from a strategic asset allocation or efficient frontier perspective, constructing the portfolio, we ran a typical optimization where we said, what is the portfolio that is required using market benchmarks or market indices in order to have the highest probability of hitting our return target. And this is the asset allocation that we've put together. And this is the strategic asset allocation which governs the portfolio over time. And you can see the building blocks there. A bulk of them are fixed income, and then we have some equity type building blocks. And so it's a barbell type approach of running lower risk and higher risk assets together, mixed together in one portfolio. So what does this look like? So on the left-hand side of this chart, you'll see that strategic asset allocation, I'll refer to it as the SAA, over time using market indices. And incidentally, that line graph there, for the period reflected, which is the period that we've been managing this fund on behalf of Select BCI, the fund hit its return target of inflation plus 3. So, you know, that strategic asset allocation does what it is set out to do. On the right-hand side, we now start to add alpha sources from security selection. And so using actively managed strategies as opposed to market indices, over the 4 years or so that we've managed this portfolio, we've generated a cumulative return of 20% above the SAA. You might ask, well, what about tactical tilts? This shows our success or lack thereof in trying to generate alpha through tactical tilts. So the darker bars in this chart represent the alpha generated from tactical tilts, and you can see that they're marginally positive and marginally negative over time, but you know, roughly speaking, in the fullness of time, it's flat, it's square. At the same time, the alpha generated from security selection is quite large. And so you can see that in the performance of the fund over the period that we've managed it, 3.7% per annum or roughly 20% per annum outperformance of the inflation benchmark. Now, you go, how do you achieve that? You've met your inflation target, you outperformed the inflation target with massive regret maximization. But despite that regret maximization, when measuring the fund's performance relative to our peers over the period from March 2017 that we started running the portfolio, it ranks first in the category of roughly 137 funds. And I think over the time that we've managed this portfolio, it's been in the top decile of performance. And so we believe that if you actually construct well-diversified portfolios where you're not that focused on regret maximization, you're not that focused on trying to be massively tactical in switching between different asset classes, you're looking for the major tilts in markets as opposed to the small cyclical tilts in markets, you can achieve both your inflation target return and you can beat your peers in the industry, in the benchmark. Drilling down a bit further, what we've done here is just reflected in a box diagram, the various periods over which we've run the fund. So over 1 year, and then the performance over 2 years, 3 years, etc. And I've tried to highlight the Select BCI Cautious Fund in orange over there. And you can see, again, even though we're using many different approaches to construct portfolios between all of the competitors in the marketplace, and I have no idea what their processes are. Some of them may be building well-diversified portfolios, some of them may be tactically tilting. The reality is that despite all of this, our approach of building well-diversified, well-constructed portfolios tends to pay off, or has paid off over time. And so I'd like to end just on one quote, and it's been attributed to many people, but the first person who used this quote was a guy called Benjamin Brewster back in 1882. And I know it must be a really good quote because I'm a staunch supporter of Tottenham Hotspurs in the UK Premier League, and they were founded in 1882. So it's a great year for quotes and great year for the formation of football clubs. But he said that in theory, there's no difference between theory and practice, but in practice there is. And the reality is that in theory, we all would love to have maximum exposure to the asset class that has the highest potential return, and minimum exposure or zero exposure to the asset class facing the greatest headwinds. The reality is that in practice, that's exceptionally hard to get right consistently over time. And so what you get in the Select BCI fund with Fairtree is a proven track record, a proven fixed income skill set, which Paul Crawford will talk to in the next session, the next panel session, combined with the equity upside and alpha sources to produce, I think, a really consistent return source. So that's it from my side. Thank you very much. I'll hand back to Tafanga.
Talk about regret maximization. I'm quite sorry for getting your name wrong, Bradley. Thank you so much on that.
Cool.
I've got a question. You're not active on tactical asset allocation except at extreme market anomalies. With the real return potential from South African bonds at CPI plus 5 to 6, which is typically an equity-like real return, is that an anomaly worth maximizing your overweight in bonds? Have you done so? If not, why?
So once again, coming back to our approach in this, we face a very interesting point in history where we've had this massive stimulus globally, which could lead to significant inflation, which could result in global developed market bonds selling off. We all know that the South African sovereign curve is essentially just a global credit. And so that global credit is referenced off risk-free. And so I don't think it's a slam dunk that South African bond yields are massively attractive and there's no risk of capital loss or capital depreciation from this point onwards. And so what we've done is we've just stuck to our knitting. We've stuck to our strategic asset allocation to South African bonds. We have at the margin tilted slightly towards it, but it's not a significant tilt at all, because the reality is that bond yields are where they are for a reason. I think if I was running a portfolio which had a longer term horizon, in other words, had less focus on capital preservation in the near term, I'd probably hold a larger exposure to South African bonds, but certainly for these portfolios, I'm a little bit more circumspect.
Okay, and I think related to your portfolio and your strategic positioning, the benchmark allows for a 10% allocation to global credit. And I think at a general high level, those spreads are quite thin for various factors. would you then consider that an extreme anomaly where you then underweight? And if you haven't done so, what are some of the reasons why you've kept global credit at benchmark weight?
So spreads have come in significantly from the peak of the crisis, but they're certainly nowhere near the lows that they were going into the crisis. There's still a little bit of juice left in that, but the same risks apply to global credit that apply to South African credit, to the South African curve. And so once again, our approach to global credit is to capture the spread and to increase the diversification in the credit portfolio by actually adding the names that are available through the global credit markets as opposed to the limited number of names available in the South African market. And then we hedge out the currency risk. And so we assume zero currency risk. We translate that spread above Euribor into a spread above JIBOR, and we maintain that as a strategic holding. So today we are once again marginally underweight, but nothing that's worth speaking about, and maintaining the strategic asset location.
No, thank you so much. Sean, you gave us an idea of asset classes that tend to do well in a high inflation backdrop. And some of the ideas you mentioned was the Japanese equity market alongside global small caps. I think we're quite familiar with the exposure to commodities in your portfolios. Could you maybe shed more light around the nature of opportunities within the small cap area globally that you're exploiting, and opportunities around Japan, and how the hedging would then take place to sort of protect on the offshore, as you mentioned?
Thanks, Luvanga. So I guess with small caps in particular, we do have an allocation to some of the more smaller and medium cap companies within the SA market, for instance. So both within the local industrial and retail type space. I guess the example that comes to mind is Cashbuild, which is a top 10 share within the Allan Gray Stable Fund, and obviously it's done well through the COVID period as people have spent on their houses, and we think that it's still got some decent growth ahead of it, and it's trading at a reasonable valuation of about sort of 10 times earnings. Admittedly, I think earnings probably are above normal at the moment, but then I would argue that perhaps the multiples on the low side. So we still think there's some room for Cashbuild to run a bit further. And there are one or two other smaller cap names within our local equity allocation that fit the bill as well. I guess talking about offshore, so our partners at Orbis adding the large sort of Japanese trading firms probably about a few months now. So I guess a good example is something like Mitsubishi, which is in our top 10 offshore equity positions. And I guess notably, Warren Buffett also has started buying positions in these firms as well, which I think sort of boosted sentiment in that regard.
Thank you so much. I've got a minute to go. And I think maybe the last part is, could you touch on the role of global property in this environment and the extent to which it can become like a potential asset worth considering in your portfolios, and maybe finish off with just your views on local property?
Yeah, so I guess for global and local property, maybe the same thoughts apply, that not all properties are created equal, and the events of the sort of last year maybe have accelerated some of the trends that we've seen, the sort of shift from bricks and mortar retail to online. I guess as contrarian investors, I think each asset does have its price at some point. And we are seeing this playing out in both the US and European markets, particularly lately, where some of the property names have actually performed quite nicely over the short term, as I think probably some of the fears about their imminent demise was overdone. I think within the local property space, the fund has benefited from a decent allocation to local property names, something like a fortress property fund, for instance. We still remain quite cautious, though, given that balance sheets aren't exactly strong. We've seen capital raises from some of the bigger funds in the market, something like a Growth Point and a High Prop, to shore up their balance sheets. And I think the easy sort of wins of the past decade of positive rent reversions and growing space, I think that's probably in the rearview mirror, and probably property management teams have to be a lot more adept at negotiating the harder times in front of them. So we remain quite cautious on property, and as such are underweight.
No, thank you. I've exhausted my time. We'll address the rest of the questions in the breakaway session. I'll hand you back to Eugene. Thanks, Eugene. Thanks, Sean and Bradley.
Thank you.
Yeah, fantastic. Thank you, Tav, Bradley, and Sean. And Bradley, I think everybody somewhere along in their lives apologize for switching the names around. But nevertheless, if you look at what you're doing with your funds, it's clear that nothing gets muddled up on the fund management side, doing extremely well. So thank you for that. Right. Next up, until 10:30, is our fixed income panel. And joining us to introduce the panel is Liam Dawson from Portfolio Metrics. Liam, thank you so much for joining us this morning as well, and your time. I really appreciate it. Just a very brief note, Portfolio Metrics is a global firm with asset management offices in Johannesburg and London. PMX have a hybrid approach to asset allocation, offering specialist building blocks, which concludes in risk-conscious solutions. PMX also have a partnership distribution model assisting through the integration of technology called Wealth Explorer, and I've had a couple of sneak peeks of that system, and I must say it's very impressive. If you as intermediaries would like to get hold of the system or find out more, then please speak to Liam. He's your man. Liam, thank you so much. Looking forward for your introduction to your panel and our next session. Thank you.
Morning. Thank you, Eugene, and good morning to everybody. So as Eugene said, my name's Liam Dawson. I'm from Portfolio Metrics. Tabonga set the scene very nicely a little bit earlier, and it is an environment that displays the unique appeal of emerging markets. Within the South African yield, the South African yield curve is perhaps the steepest investable yield curve in the world at the moment, and certainly so versus our own history. All right, so we also see a very low and stable inflation setting us up for a very accommodative monetary policy approach, supportive to any green shoots that our economy may sprout. On a fiscal and governance front, there are plenty of questions, and these pose the significant risks to investors. On one hand, fixed income managers have a rich investment opportunity that our global peers could only dream of. But in order to take advantage of it, they need to take risk. They've been asked to take risk, and this is not always in their nature. With us today, we have three managers who will all speak to their own approach of risk-taking. We will have the opportunity to ask them questions now and in the breakaway room this afternoon. So please, I encourage you to take advantage of this opportunity. You've got direct access to some very skilled managers. First in that list is Sydney McKinnon from Katie's, who will discuss the low rate environment and the high real yield available here in South Africa. Following up, you'll have Paul from Fairtree, quite well known in the industry. He's been around for a while. And of course, he'll take us on a short history lesson and unpack how global credit is beneficial to South African investors. And then lastly, we have Melanie from Laurium Capital, who will decipher the global environment that we currently find ourselves in, and specifically how South Africa fits into this 1,000-piece puzzle. All right, so Sydney, I hand over to you to please wow the audience.
Thanks, Liam. Thank you for that introduction. And let me just share my screen so that we can all see the presentation. So thank you for that. I really appreciate being here today. It's nice to be here. My name is Sydney McKinnon, as Liam has already said, and I'm from Katie's Asset Management. And I'm here today to talk to you about making sense of a low interest rate environment. When I thought about this topic, I thought that, it is said that low interest rate environments are there to provide stimulus and growth within an economy. And it's also there to make it easier for you to borrow money. So an environment where the borrowers stand to benefit, and then of course your investors and savers might not always be that lucky in terms of the rates that they can receive. But I thought let's first have a look at the textbook definition. And the textbook didn't help much. The textbook said to me that we are in a low interest rate environment when the rates of interest are lower than their historical average for a prolonged period of time. Now, a prolonged period of time is a relative term. So how long is prolonged? A year, 10 years, 20 years? You know, it's by the definition, it's not always easy to understand whether we are in a prolonged low interest rate environment, but it most certainly feels like it. It does feel like it. So just looking abroad, if I look at the US market and I look at the Fed's funds rate, we all know this, we see if I should look at the historical average over the last, say, 20 years, if you can consider that a prolonged period, then most certainly we are below the historical average of about 1.7%, where the Fed fund rate is below that. And we've come through periods of quantitative easing, monetary policy easing, you know, and all of these things to try and stimulate an economy. Has it really done so? Maybe not decisively, but we've had little pockets of stimulus. And then let's not forget all the event risk that's been in the system. I mean, COVID-19 being the last one. But most certainly, as a result of COVID, we've seen these aggressive rate cuts. And that's in the last year and even in the last 10 years, and that is to try and stimulate growth, especially in the developed economies. So has this really helped? Are we in a low interest environment? It most certainly feels like it. And I think most recently exacerbated by the fact that we've had these aggressive rate cuts in the last year. Bringing things a little closer to home, I cannot talk about our environment in South Africa without looking at the factors that drive interest rates. And there are many. There's a myriad of factors, from economic fundamentals to monetary policy to valuation, liquidity, all the rest. But I thought I'd pick one or two of them just to illustrate the point and to try and unpick this making sense of being in a low interest rate environment. And I thought the first fundamental I'd look at very briefly is growth, and it's very topical, it's very thematic at the moment. We all feel that we're going to get a gradual recovery. Hopefully the vaccine rollouts will be good enough. And but if we look at our local environment, we've seen our mining sectors, finance sectors struggling. The point I want to bring home here is that it's in the numbers, and the numbers have been maybe exacerbated by the fact that we're coming from this thing called a very low base. So any good number is a little bit conflated because it's coming off a low base. So let's not forget the fact that we still have quite a bit of event risk in the system. We've got electricity constraints. We've got SOEs that are potentially defaulting, higher unemployment, business confidence that is low, and we're not out of the woods as far as COVID-19 is concerned. The other fundamental that I want to just briefly touch on from a local perspective, getting to this point of are we in a low interest rate environment and how can we make sense of it, is inflation. And I know my learned colleagues over the last few days or so have been speaking quite a lot about these fundamentals, and we've seen our inflation rate pick up in recent times because of higher administered prices and fuel prices. Food prices have moderated a little bit because of good rains, bumper crops. But once again, my point I'm trying to make is that embedded in a lot of our fundamentals is this low base effect. We're coming off a low base effect. And that's why the inflation numbers are appearing a little higher. The demand is still very weak in the system. So it's not the demand that's pushing up inflation and then, of course, by virtue, rates itself. So if we should look at our interest rate environment by looking at a measure, and let's use the measure that's most commonly used, and that is our repurchase rate. And I thought let's just have a look at the repurchase rate over the last 20 years, and let's try and reflect that back to the textbook definition of being lower than average for a prolonged period of time. Most certainly, I just took an arithmetic average over the last 20 years, and it comes out at about 7.7. So most certainly we are below the average, which kind of confirms that we are in a low interest rate environment for a prolonged period of time. But as I said earlier, inflation expectations haven't increased sufficiently to push rates up. I mean, we've seen the Monetary Policy Committee and the SARB saying their model is saying two rate hikes this year, but it's merely a policy guide. The fact is demand is still very weak in our system, and the real growth is still fairly subdued. So by just looking at this measure of the repo rate, and from a global perspective, let's look at the Fed funds rate, yes, we can agree, I think, that we are in a low interest rate environment. What I really would like to propose is that we just look at things slightly differently, and from a slightly different angle. And another way of looking at our rates or yields is looking at our nominal yields. And I thought, let's have a look at our bond yields, our 10-year generic bond yield over the last 10 years or so. And does this reflect that we are in a low interest rate environment? Bond yields actually over the last 10 years have been fairly stable, maybe even risen a little bit. So from a nominal yield perspective, it doesn't quite appear, and there's all this talk, and my colleagues early on also spoke about value in the bond market and where the value is and where along the yield curve it is. From a nominal perspective, it doesn't quite feel that you are in a low interest rate environment merely looking at nominal yields. But I think the important thing is to take out inflation out of the equation and look at what is left, and that is our real yields, because at the end of the day, if you are investing for real returns. It doesn't matter what you are investing in. And I looked at our real returns as another angle of looking at rates and whether we are in a low interest rate environment. And real returns have been also maybe even slightly higher than what they were 10 years ago as well. I know we came from one point where real yields were quite high, but from a real yield perspective, it doesn't quite feel as if you are in a low interest rate environment. It looks like there is money to be made or value to be had. But I think the best way is to superimpose these two graphs and then just look at the differential, which is effectively the gray shaded area in this graph, which represents inflation, and I think, or expected inflation. And I think that is why you found this little uptick in real yields, because you subtracted inflation, which has been declining over the last couple of years. You would find yourself with a better real yield. Now, the question really is, so how do you actually take advantage, or how do you actually invest in a low interest rate environment? And I think the important thing is to try and obtain real yields at the end of the day. That's really what you're looking. Whether you are in a high interest rate environment, whether you are in a low interest rate environment, whether you are in a, if there's such a thing as a medium interest rate environment, you're really trying to target real yields. And as I said, some of my colleagues yesterday and today have been speaking about this issue about what asset classes you can use. And one of the ways you can do it is to look at your cash, use a cash type strategy. And I just used the Steffi as a proxy for cash, and then I plotted in the green line inflation, and then of course the break-even is just the difference between the two. And your cash strategy doesn't always work. I think that's quite intuitive, because it really comes down to the fact that in a low interest rate environment like we are now, so absolute yields come down, your ability to then start performing above inflation and to extract real yields is very rarely, you're really capable to do that by being in a cash strategy only. However, a cash strategy gives you liquidity and all those wonderful things, I think, but it's not always possible by being in a cash strategy alone. And then a lot of the speakers have also spoken about adding maybe some credit into your portfolio. I use Steffi plus 1% as a proxy for adding credit, targeting credit in a portfolio. And yes, this credit can help your portfolio quite a bit, but by imposing credit in your portfolio, you start introducing things like default risk and counterparty risk and all of those nice things into your portfolio. So diversification is very important, and you may sacrifice some liquidity, but you can start getting a better than inflation return by imposing a credit type of strategy. The other strategy you can use is by adding in some duration, and we've also spoken about the bond curve and the bond yield curve and where the value is along the curve, and whether there is value to be had if you had the time and you had the investment horizon. And if I just use Steffi plus 2 as a proxy for duration type targeting funds and extract and subtract inflation from that, it does help. But of course, There's the issue of perhaps capital loss in your portfolios, and as Bradley said earlier on, you know, is it really a time to be heavily invested in bonds because of that very fact that you introduce that capital risk within your, and potentially higher volatility within your portfolio. So I think the important thing is know your return expectations. At the end of the day, know what you are shooting for, know what you are wanting to get at the end of the day. In this current, and I put low interest rate in environment before you, it's a lot more challenging because your deposits and your cash rates are quite low. So you need to beat inflation, and your appetite for risk then has to potentially increase a little bit. How much volatility can you take? How much risk can you take? What are the other asset classes that you can get involved in order to achieve the risk, the inflation beating returns that you are looking for? So in short, it's really the case of choosing your weapons very wisely. And we've got an array of asset classes available to us, anything from money markets to currency to bonds to equities. One of my colleagues spoke about inflation-linked bonds as a potential asset class that one could get invested in. But I think the important thing is try and aim for that inflation-beating returns. Really, it's keeping it real at the end of the day. So in summary, we've seen rates come down. We are in a low interest rate environment, really from a textbook perspective. Rates have been cut by developed markets and most of emerging markets over the last decade. But just looking at it from a slightly different angle, you've seen nominal rates maybe rising marginally, real rates also a little higher. But the important thing is to try and know what your benchmark is, know what your target is, try and get that, try and keep it real, try and adjust your expectations so that what you're achieving at the end of the day is a real return. And you know, I can speak forever in the day about various ways and technical ways of doing it, but time is very limited today. If there's any message that I could have brought across today is whether you are in a high interest rate environment, low interest rate environment, and if there is such a thing as a medium interest rate environment, try and keep it real, try and beat inflation at all times. Thank you.
Thank you, Sydney. Well, hello from a rather wet and blustery London. It's interesting. I've actually been given these, lucky enough to have been invited to present at these annual events, literally since 2012. That's basically 9 years. And I remember back then, I was not only the only person talking about credit over the course of the couple of days, but I was also the only person talking about fixed income securities over the course of the 2 days. Now we have got 11 speakers, if I include my colleague Bradley, who is essentially a fixed income guy, 11 speakers out of 42. So that's slightly more than 25%. Which certainly shows you the acceptance of the asset class and the interest that's been pricked over the past sort of 10 years. So that's quite interesting. Anyway, let me carry on. So I'm not a lone voice anymore, which is good to hear. Okay, so today I'm actually going to be talking about a few things, and I'm going to do it all in 15 minutes, which is going to be interesting. I'm going to start off by talking a little bit about the performance of the asset classes, just to sort of answer the question, why has fixed income suddenly become almost like quite fashionable to invest in? And I'm going to talk a little bit about global defaults. So I'm going to actually take from a global context, this risk that everybody talks about, this credit risk and too tight spreads and stuff like that. Let's actually just have a look, at the data rather than people's sort of opinion on it. So I'm going to talk about global defaults and then essentially what's actually priced in at the moment with regards to European credit. I'm then going to talk about another very topical issue right now, and I've heard quite a few speakers speaking about this over the past day, and that's the South African bond market and its oozing of value, as it were. And then obviously just sort of finish off with a conclusion. So let's have a look. Okay, so I've actually sort of indexed the STEFI to the end of February 2014 for a specific reason, which you'll see just now. But essentially, this is its total return over the past. It works out to be about 7.25 years. It's from the end of February 2014 to the end of April 2021. So you see, it's a nice smooth return. This isn't real. I haven't included CPI, which I can talk about a little bit later. What inflation has actually taken away from your returns to cash. But you can see essentially that curve, that little line is pretty damn smooth, right? So there's literally been no volatility. I call it risky, risk-free, because essentially there's no such thing as risk-free. There's nothing which doesn't have any risk. I don't care whether it's money market securities or government bonds or whatever. There is nothing essentially with risk-free. There is small amounts of risk, but there's no concept of risk-free anymore. The other thing as well is, of course, if we have a look at the performance, this is obviously all pre-tax. So I'm not going to start discussing about tax. That is not good for a fixed income guy to talk about, to be frank. Over the course of that period, I've got the bonds or the all bond index performance over the same period. And you can see that little green line actually does outperform the red, thank goodness. So there has been a sort of positive return to risk. So bonds have outperformed, which is quite good to see. When we include equities, I've called this chicken or beef because, I mean, just like when you get on a plane and you know, one of the attendants comes and asks, would you prefer chicken or beef? The two of them sort of taste the same, right? It's like plastic food, right? At the end of the day, whether you invested in equity or bonds, you get, over this period, you have basically the same returns. The blue line you can see is a lot more volatile than the green line. So you marginally outperformed, and that may have actually reversed during the month of May because bonds are having a great time whilst equities have actually underperformed to yesterday. You can see that it's a lot more volatile. So there hasn't been that sort of good returns to equities over this period. If we look at the BCI Income Plus Fund, which is a fund which we've been managing since midway through February 2014, the credit fund of the Income Plus has actually outperformed both of them over the longer term. Now remember, this is 7 years. Investing is for the long term. Last time I looked, it's not for speculating or day trading or game stopping or Bitcoining or whatever you want to, whatever's fashionable on that particular day. It's investing, last time I looked, was for the long term. And the Income Plus has outperformed. It's outperformed the ALBI, it's outperformed equities, and it certainly outperformed STEFI. And remember that during this period, we certainly had COVID. The pandemic hit last year. Obviously, you can see all markets sort of got crunched, including the BCI Income Plus also lost, obviously, during that period. They're all risky funds in one way or another. Interesting what I've got, and this is what I'm going to talk about relative to bonds. I've also included the Proton Fund, which is our fixed income flagship hedge fund, fixed income, of course, not equities. And that you can see again, a hedge fund, hedge fund, you know, the dreaded H word, has actually outperformed all of them. And it's outperformed them at very, very low risk. And I'm going to talk a little bit about why I sometimes come across as a really bond bear. But the funny thing is, I'm not a bond bear. I'm actually sort of, I love the asset class. There's lots to do with it. There's just very little to do with it in long only space, which I'm going to take you through just now. So anyway, when we look at these returns and look at them in terms of return and risk, this is sort of what we get. So I've actually just got annualized returns shown on the y-axis and risk as proxied by the standard deviation of monthly returns on an annualized. I get the risk on the x-axis. And you can see, you know, equities in blue, all being green, Proton, the hedge fund in that box, and then Steffi in red, and then the Income Plus fund, which is in the orange. So you can see essentially what I'm showing here is that the combination of cash and equities actually underperformed the ALBI. So the ALBI actually outperformed its risk-adjusted combination of equities and cash, which says a lot for fixed income and fixed income portfolio managers, which is probably why everybody's sort of beating their chests and saying why bonds are such a fantastic trade these days. Unfortunately, that outperformance is actually absolutely murdered by what's being produced by both the Income Plus fund as well as the hedge fund over the same period. So yeah, you have been dominated, well, bonds, the old bond index has been dominated by a simple credit strategy, as well as a rates and credit strategy being the Proton hedge fund. We have a look at correlations, yeah, and mean annual returns. Oh, yeah, this is just basically what we watched, what we've seen on the last graph, but put in tabular form. The interesting thing is obviously the correlation parallelogram on the bottom, which for those of you that are interested, I mean, correlation numbers sort of mean everything to me. Those are probably the most important thing to look at. So now I'm going to talk about just very, very briefly the problems with bond funds. You know, and it basically is that it's like, yeah, taking a sword or a knife to a gunfight, you know. Yeah, as soon as you have the BN90 constraints implied upon a bond fund versus a largely unconstrained hedge fund, although you do have refs and quiffs these days, you're onto sort of hiding to nothing. I mean, here is the sort of strategies that you can play, you know, and I don't care what anyone says. I'm an ex-bond fund manager myself, and actually we do have a bond fund. The Proton fund has got 18 different strategies it can choose from outright bond swap spreads, relative value bond spreads, FRA spreads, forward start swap spreads, swap direction, swap curve trades, swaption vol surface trades, cap flow straddle vol trades. Hey man, I mean, there's infinite dimensions here. MPC vol trades, yeah, there's a whole lot, yeah. If you have a look at an all bond index, and trust me, yeah, there's basically 4 you can do, right? So there's duration trades. Yeah, you can do credit outright. You're lucky if you can do tranches, and you're lucky if you can do credit indices. So it's just one lever. And, you know, I've spoken about the central limit theorem several times over the years, and the less levers you got, the more chance you've got of underperforming your index that you're trying to beat. So I would argue it's a very, very constrained sort of place to operate. So it's not good. I can see I'm actually running a bit over time already. So let's have a look at global defaults quickly. These are the number of defaults. When I talk about defaults, I'm talking about large corporate defaults with CDSs attached to them. So I'm not talking about sort of mums and pops or small little firms. Well, when I talk about small little firms, I would even include Land Bank there with its sort of 40 billion that it's defaulted on. I'm talking about large firms, large international firms. So this is actually the number of defaults since 2005 to May 2021. So you can see it's sort of cyclical, number one, and number two, what we've witnessed over the past sort of 12 months is nothing in comparison to what we've seen in 2009. If we look at the other side of the coin, and that's sort of not just the defaults, but the recovery, you can see that essentially a recovery level of around about 40% is probably about right. So whenever you see anyone talking about using recovery levels of 40%, it's correct. So what's priced in at European credit? I'm going to do this in 4 minutes. I see I'm running low on time. This is a European credit spread. This is the iTraxx crossover index. It's our favorite index to use. And this is its over time. And as Bradley actually pointed out, spreads are tight, but they're nowhere near as tight as what they have been in the past. And they're nowhere near as wide as what they were way back in 2008. So they're sort of in the middle of nowhere. I'm going to skip through this slide. This index itself, 75 names. By the way, these are the names you'll know about more than about 25% of them. I mean, yeah, I'll go through them at your will. There's Air France in there. There's M&S in there, even Marks and Spencer. Everybody knows this. And that's a name which has sort of moved from iTraxx main to iTraxx crossover a couple of years ago. Don't worry about that. So what's priced in at issuance? Well, this is a number of expected defaults. So you can see that we're now in S35, and you can see that there's quite a lot of default expectations in the market. That's what's priced in. Here's what's been delivered. So this is the actual number of defaults per series. And relative to what was expected, you get excess return for actually just receiving that spread, because what was priced in compared to what was delivered is two different things. It's been said a few times that iTraxx crossover, European credit spread and South African credit spread, is essentially one and the same thing. This is showing that. So I've got the iTraxx crossover indexed and the South African 5-year CDS spread. Yeah, it's the same thing. And in fact, the next thing I want to say is iTraxx crossover and SX5E, which is a European equity index, same thing as well. So let's talk about South African bonds all in 2.5 minutes. The question is, are they a slam dunk or are they a dripping roast? Well, yeah. Here's the yield curve at the end of 2019. So the yield versus the tenor. Those are the most liquid bonds. And then I've got it to the end of April. Two things. One, the curve has steepened. Sydney spoke about that in his last talk as well. Steepened dramatically. And this is what everyone's in a jam about. Why are we so steep? We're the steepest in the world. Oh, goodness, great. Yeah, we have. We've got steep. That's a fact. So the bond market certainly has not kept pace with the caps and repo and 3-month JABA. So the curve is steep. Well, I'd like to say for the people with the fear of heights, if you have a look on Amazon, you'll get a good couple of books on how to overcome your fear of those heights. The curve's steep for a reason. And then people show statistics where the steepest we've been, and we've got 89th percentile making money. Yeah, the reason we're steep is because SA debt to GDP ratio has gone ballistic. I mean, we're at all-time highs in debt to GDP ratio. Yeah, arguably someone will say, yes, but look, it's only 77%. And yeah, but Japan's at 200% and the US is over. Yeah, at the end of the day, they don't have nominal yields what we have. So our debt burden is dwarfing those countries with much higher debt to GDP. We cannot afford high debt to GDP ratios. So yeah, it's a bit of a joke. So the question is let's hope it's just not a no-brainer. And with that, I mean that no-brainer, i.e. that you're investing in bonds because, yeah, you don't even want to say that. So in conclusion, and I have done it within my 15 minutes, the returns of the BCI Income Plus have been well established through time. All bond indices, all bond funds, they've got one duration to play in that, the one lever to play, and that's it, and that's duration. That's it, nothing else. iTraxx crossover, it's not voodoo. It's not something you've never seen. You know about 25% of those firms with a lot of risk priced in already. The South African bonds, the curve is steep. That's a fact. It's steep, and it's steep for a reason. So I'm seeing a lot of switching into bond funds. And yes, do it. It's a very liquid asset class. You'll get in and out. But remember to measure what you're doing and be accountable for what you do. And that's it. So that's what I've got to say today. And thank you for listening.
Thank you, Paul. And now from a cold and blustery Cape Town, so don't feel so bad sitting in London today. What I thought I would do today is, let's make it this up and running. What I thought I'd do today is, we all know that the COVID pandemic had such a huge impact on both economies and investment markets. And what I really wanted to do is just pause and think about how have these influences changed the way we think as fixed income investors, both on a short term, so what we would call a cyclical basis, as well as on a sort of a longer term structural basis. What has changed and what has not changed? What can we extrapolate into the future and what not? So, as good old fixed income investors, we always start, the first building block of our bond valuations always starts with a global risk-free rate, so what's happening in global bond markets. And if we have a look at this chart here, sorry, just going to minimize this. If we have a look at this chart here, we all know we've had a lot of stimulus in this cycle. So the COVID pandemic really, in our minds, we saw a big shift in the mindset of policymakers in the use of fiscal stimulus. So we'll recall after the global financial crisis, we really had a period where there was so much heavy reliance on monetary policy as a tool by policymakers. So, low interest rates, negative interest rates, quantitative easing, it was all very much concentrated in that area. And clearly now, that has all changed in this pandemic. So we've seen a complete mind shift change. And if we look at the US just as one example, both in terms of the sheer size of fiscal stimulus, but also at the same time, the creativity they've had in widening their toolbox. So they've sent checks to individuals. I mean, this is quite unprecedented. It's been really, really interesting. And if we have a look at this chart here, we can see this is really a percentage of GDP, fiscal stimulus by different countries. And the US really tops the chart on the left. And there are two things that are obvious from this chart. The first one is that the green bar was the fiscal stimulus deployed in the GFC. So very much smaller than what we're experiencing now in this crisis. And then secondly, if we look at this bar, we can see the gray those are the stimulus measures announced this year alone under the Biden administration. So, really, really different way of thinking about this as a policy tool. And if we couple this large fiscal stimulus with the rollout of vaccine programs in developed markets, with most DMs expected to receive some element of herd immunity by at least the end of the year, if not sooner than that, this is leading to the successful reopening of economies. If we then look at the right-hand chart here, this has clearly significantly changed the growth outlook for the US. So we're expecting growth rates in the US of 7% plus this year. I mean, those are really, really big numbers. But if we think about the path of growth, what we can see on the right-hand slide here is that, the US really was on a pre-COVID growth path, was then knocked off course with COVID, and then started to grow again. But there's a key difference between what was expected in December last year. So if you look at the light blue line, that's pre-Georgia runoffs early in January this year, the US economy was expected to recover, but recover slowly and take quite a few years to reach that pre-COVID growth path that it was on. That's all changed given these dynamics. So not only is that gap now anticipated to close a lot faster, if you look at the dark blue line, but the US economy is actually anticipated to grow above those pre-COVID growth path levels for a period of time. So a completely different view that we're seeing right now. Obviously, the same factors that are leading to the strong bounce in growth is also leading to a strong bounce in inflation. And as we can see here, inflation, if we look at core CPI in the States, really just bobbed around 1.5% to 2% for so long. That's expected to shoot significantly higher this year. And then most economists expect it's going to come back down again, back to central bank target levels. And that's really a key question that we have to ask as fixed income investors right now. And everyone's scratching their heads about this. Is this something cyclical or short-term due to a surge in demand? We'll see a short-term surge in inflation. Or is this something more sustainable or durable? Do we need to think about much higher inflation rates on a longer-term trend? And markets themselves are quite confused at the moment in terms of how to express this view. So two charts here. The first one is if we look on the left-hand chart, these are break-even inflation expectations. So US inflation expectations stripped out of the 10-year point of the curve. You can see how that red line has jumped quite sharply, but still not exceeding what we've seen in previous cycles. And if we look at the right-hand chart, this shows you the US 10-year bond yield. We're obviously off those incredibly low levels we saw in the middle of the pandemic last year. So 0.5% on US 10-year yield sounds mad. We're now at around about 1.6%. So there's been a big shift higher, but at the lower end of the trading range that we've seen for recent years. So market consensus is still out on this one. At the same time, we've got these high growth expectations, higher inflation expectations this year. This has obviously had an impact on commodity prices. So we can see on the left-hand chart, commodity prices have soared, which is fantastic for South Africa. So if we think about, South Africa, what we export commodities that are very much in demand at the moment. This is fantastic for our trade balance and our current account. So in isolation, this factor alone substantially reduces our risk vulnerability as a country at this point in time. So if we summarize and put all of these factors together, then we've got what we see as an expanded global fiscal policy toolbox. We certainly don't expect this policy to continue. That's going to fade over time. You can't have this amount of stimulus every single year. But I think what's important to understand is that the way that policymakers are thinking about fiscal policy has changed. So that would be a structural element. Secondly, we've got higher US inflation, and this is really the question in financial markets right now. Is this something short-term, cyclical, transitory, the Fed will say, where it just bumps up and then comes back down again once we get through the next few months? Or is there something more structural at play? This is really where someone like a Larry Summers, the ex-US Treasury Secretary, and many other commentators are saying, they're concerned about this interplay between large fiscal stimulus and a Fed that they see as being behind the curve. So you've got these two polarized trains of thought. Good news is we'll know by the end of this year or next year whether this is just a transitory bounce or is it actually feeding through to wages and inflation expectations on a more durable basis. Obviously, these factors are being reflected in higher commodity prices. Is this something cyclical or short-term due to a surge in demand and problems, bottlenecks in supply? Or is this something more durable? Is this a super cycle? I'm sure this is going to get some airplay on the conference this week. Is there an ESG-related demand component that needs to be priced in? And these factors leading to an increase in the risk-free rate. So increase in US Treasuries, always an unsettling time for emerging markets as US Treasuries need to find some sort of new equilibrium level. But if we lift our heads for a moment and we think, why are Treasuries rising so significantly? We've got synchronized global growth, we've got a much better and open global trade environment, or opening, and we've got strong commodity prices. These are fantastic for South Africa. So when we think back to 2013, which is when we had the Fed taper tantrum, there are some differences. The first one is that the Fed is very aware that they don't want to cause another taper tantrum, in terms of messaging and communication. We'll see if they're successful on that. But secondly, if you think back to 2013, South Africa was one of those fragile five, where there were 5 emerging markets which got a lot of airplay, where we had very, very big current account deficits. South Africa was 6% current account deficit as a percentage of GDP. That's clearly very different right now in terms of our current account surplus. So not to say we're not anticipating volatility, of course we are, but we do have to recognize that there are differences to that period when doing comparisons. Focusing then back domestically again, we as bond investors think about a couple of things: growth, interest rates, inflation, fiscal policy. What do we think about that? So first of all, if we think about growth, if you look at the left-hand chart, we can see, similar to the chart we looked at in the US, SA was on a pre-COVID growth path, which is the blue line. We then had this big contraction, so big recession last year, which knocked growth down. In fact, so severe, it took us back to 2007 output levels. So that's a big recession, starting to grow again. But what's clearly different to the US growth path is that it takes us, we grow a lot more slowly, and it takes us a lot longer to start to close to that gap, the gap to the pre-COVID growth path. And on the right-hand side, what is obvious, but it's unusual relative to previous recessions, the recovery across sectors is very different. So if we look at sectors like the agricultural sector, which is the green line at the top, that is completely outperforming. It had much fewer lockdown restrictions, but importantly, very favorable rainfall conditions last year, which led to bumper maize harvests. Relative to the lines at the bottom, things like the construction sector, those sectors related or who rely heavily on tourism, particularly hard hit, and will take a much longer time to recover. So what about interest rates? Well, we do know the SARB acted incredibly quickly last year. So going into the crisis, we had interest rates that were around about, they're at 6.5%, the repo rate. The SARB cut rates quickly and significantly down to 3.5%, so almost halved interest rates over that time. And we've got interest rates right now that are the lowest we've seen in 5 decades, which is an incredibly long period. Do we think this is now structural, that this is the new normal? No, of course not. These are really emergency levels of interest rates. But why was the SARB able to do that and provide so much accommodation? Well, it really was because of inflation. We look at the left-hand chart here, we can see this is actual inflation, CPI. The SARB is mandated to keep inflation between 3 to 6%, which is the dotted lines on the chart. And you can see that for so many years, inflation really hugged the upper end of that range. So around about 6% it bobbed and weaved. And in recent years has come quite sustainably down towards the midpoint and even the lower end of that target range. And if we look at the right-hand chart, this is SA inflation expectations. So what price setters think about inflation on a longer term view. Same trend, we hugged that 6% upper end for many, many years, and only recently has started to come down, looking seemingly sustainably towards the midpoint of that target range and seemingly quite well anchored. The real impact that the COVID pandemic had on South Africa bonds was really through this fiscal channel. So, we went into the crisis as a country with a debt to GDP level that was already too high for comfort. So rating agencies have always said to us, as Paul was mentioning, as an emerging market, at 60% debt to GDP level, really, if you go through that, the warning lights start to flash, and we were at those levels going into the crisis. We then had two things happen. We had GDP drop like a stone, and we had expenditure not only stay constant, but actually increase due to COVID-related expenditure. So if you think of what debt to GDP would have done over that time, we can see it in this left-hand chart here, it really ballooned. So we've had two updates. We had a mini budget, midterm budget policy statement in October last year from National Treasury. And you can see in the red line on the left how they anticipated that debt to GDP bounced or shifted incredibly higher and was expected to peak just under 100% debt to GDP. The budget this year showed a better picture, expected to peak just under 90% as a debt to GDP level, but still, way too high. It's quite substantially higher than that 60% rule of thumb that we were talking about. The reasons for this, if we look at the right-hand chart, was really that South Africa went into this crisis with a pre-existing condition. So if you look at this chart, you'll see that the red line shows you the budget expenditure, excluding interest, over a number of years as a percentage of GDP. And the grey line shows you the revenues collected from the economy, so taxation and so on, that's used to pay for that expenditure over a long-term period. And you're probably scratching your head looking at the chart saying something doesn't make sense. And you're right, it doesn't. The grey line is below the red line and it should be the other way around. And this has been the reason for this debt, this build-up in debt vulnerability leading to what could or may not be a debt crisis over time. Obviously, COVID exacerbated that, but we went into the crisis at vulnerable levels already. And there's no easy way to fix this. It can only be done the hard way. We need to do two things. We need to lift the grey line by increasing the economic growth rate of the economy, using structural reforms and so on. And we need to bring that red line lower by cutting expenditure to affordable levels relative to the revenue that we collect. It hasn't all been bad news. So the commodity windfall that we were talking about is a really important impact that we need to consider. So if we think last year, the shortfall in revenue collection from the budget last year to what actually happened. In October, that was anticipated. We would fall just over 313 billion rand short of expectations due to commodity prices being so high and resources companies paying more taxes and growth being better than expected. That shortfall actually only ended up being 175, but still a big shortfall, but less severe than had been anticipated. And these dynamics have led to National Treasury reducing the amount of issuance into the market on a weekly basis, which is the right-hand chart. Very, very high levels last year in the middle of COVID, and that's come down a bit. Still very, very high, but there has been an important delta impact there. Summarizing all these factors together, we know in South Africa, our growth recovery has been much slower than developed markets, much less fiscal support and slower vaccine rollout. Interest rates are at emergency levels right now. They will need to rise as growth recovers, but, and that's cyclical, so it's at a cyclical low. But if inflation remains well anchored at 4.5%, the new normal of interest rates can indeed be lower than what we've seen in the past. That could be a structural trend. The government debt burden increased alarmingly. COVID exacerbated it, but South Africa was already living beyond its means. We have this really nice window of opportunity right now where we have revenue outperformance with better growth, commodity windfall. This is a cyclical overlay, but we have an opportunity as a country and as National Treasury to use the cyclical opportunity to lift that growth trend rate, implement those structural reforms, and reduce expenditure by keeping the public sector wage bill and so on at healthier levels in order to reverse the structural debt trend. And this is the reason why there's such a big risk premium in the yield curve and why the yield curve is so steep. It's there for a reason. If we can make progress and stick to fiscal consolidation using this commodity windfall, this could make bonds an incredibly attractive investment if we start to see progress on this front.
Thank you so much, Melanie, and to the other two speakers as well. We've run out of time as far as questions go. So I do see one or two posted. What we'll do is we'll carry them over into the question and answer session this afternoon, the breakaway session. So again, thanks to the three speakers. And I believe we're going to move across to some global equity discussion now.
Yeah, thank you very much, Liam, Sydney, Paul, and Melanie. Sorry we ran out of time there, but like Liam said, we'll carry those questions to the breakaway room. So remember about the breakaway rooms afterwards. If you did post questions in this session, we'll carry them over, we'll address them there. Chicken or beef? Well, that's the question, I think. We will now look at a short recording by the one and only Terry Smith, founder of Fundsmith, showing some of the highlights from the annual shareholders meeting. And just a short note to the audience, there will be there won't be a Q&A after this session, but you're more than welcome to direct any of the questions on Fundsmith or the BCI Fundsmith Equity Feeder Fund to any of the BCI sales team, which will then direct it to Grenville Ward from Fundsmith, and we'll be sure to get some answers through to you. Dan, if you can cue that video, start the video for us. Thank you so much.
Welcome to the annual shareholder meeting for this Fundsmith Equity Fund for 2021. I'm just going to run through my usual presentation. If you look on the screen, you'll see that the return for the fund, that's the T-class accumulation shares, the ones that I'm invested in, along with you, delivered 18.3% return last year, compared with equities, the line below, 12.3%. That's the MSCI index in sterling with dividends reinvested. So we outperformed the index by 6% last year. If you look over to the right on the screen, you'll see the annualized return since inception is 18.2% per annum, and the annualized return from equities is 11.9%. So actually last year was slightly better than average, but pretty close to what we've done in the average year. And it would be pretty tempting, therefore, to assume that last year was an average year. Of course, as we know from the simple fact that I'm talking to you remotely, it was anything but typical. And I think that brings home quite an important point in terms of not only our performance, but the performance of equities last year. In the annual letter which I wrote to you, you'll see that I say in there, imagine that when I was writing that annual letter in January 2020, that I was capable of perfect foresight in terms of events, and that as a result, I was able to tell you that there was going to be a pandemic, and that the pandemic would cause reactions which were so severe that the global economy would go into recession, and that the biggest economy in the world, the US economy, would have a fall in GDP of 9.5% in a single quarter. And if I told you that in January last year and you knew I was right, what's the likelihood that you would have decided just to maintain your investment in equities? Probably pretty low, I think. And so you'd have missed out on this 12% return on the index, never mind the return on our fund, if you'd taken your money out in the light of that prediction. Now, that I think illustrates an important point. An awful lot of people talk about so-called market timing, whether you can take your money out and miss dips in the market and put it back in at a low and gain from the rise in the market and foresee events and profit from that. I don't think that's possible. I've certainly never met anyone who can do it, and I know I'm not capable of doing it. And I think what last year's events illustrate are, even if you had perfect foresight, it's impossible because you don't know how the market will react. Even if you could foresee the pandemic and the downturn in the economy, would you be able to predict what the market would do? I don't think so. What did we actually do last year? I've touched upon this already, but just to give you the details. We sold 2 companies, Clorox and Reckitt Benckiser, and we bought 3, and we've been buying a new position recently for the fund. Clorox and Reckitt Benckiser, pretty similar story there. Clorox is an American consumer products company. It mainly makes household cleaning products. Clorox is in fact the name of one of its major brands, bleach. So bleach, disinfectant wipes. It makes some other household cleaning products, and it also makes some personal care products. Reckitt Benckiser, main products are household cleaning products and over-the-counter medicines and some infant formula. Both of them had a very big rise in share price in the second quarter as a result of the panic buying by people in the household cleaning products, disinfectant wipes, over-the-counter medicines area. And in both cases, we thought that the share price got somewhat out of kilter with what we think the long-term prospects of these businesses are. At the same time, if you look in the purchases column, as Nike and Starbucks in particular had 40% falls in their share price, roughly speaking. We like Nike and Starbucks, they're companies we wanted to own, so we took this opportunity, as we see it, to sell Clorox and Reckitt Benckiser and buy the Nike and Starbucks positions. Nike, I'm sure you're familiar with it. It's the world's biggest sporting apparel business, world's biggest retailer of trainers. It's a company that makes about a 30% return on capital, so it fits our bill. Been growing at about 10% per annum. If you look at the market research on this, there's probably no other company in retailing, certainly in sports goods retailing, that's as well adapted to digital sales and e-commerce sales as Nike. And obviously, given the circumstances surrounding this pandemic, that's been given a huge boost during this period. So we thought the share price was actually rather out of kilter with what was happening fundamentally with this company. Starbucks, obviously it was hit by the pandemic because the city centre stores that most of us are very familiar with, where you go in and sit down and have your coffee, were closed as a result of this. So it obviously did injure the business, but there are a few things to say about it. One is, again, it's a very good business. We're talking about high 20s returns on capital, long-term growth at about 7% per annum, obviously dented last year by the events. But a couple of things are, one is, the city centre sit-down sort of format for this franchise is not the only format. They also have drive-through and increasingly kiosks. And if you wanted to see the power of a brand, you should look up online some of the often spectacular traffic jams caused by queues by people doing drive-through at Starbucks. This is obviously A, not their only format, the sit-down format, and B, they've got very powerful brand loyalty. The other thing is that I think they got a big opportunity as a result of the pandemic. During the course of it, their biggest competitor in their second biggest market, the second biggest market being China, and their competitor there being Luckin Coffee, was exposed as a fraud. And as a result, was damaged as a competitor to the Starbucks business. So I think they've got quite a clear run in terms of expansion in China for the near future, basically. So we took the opportunity to buy those. We also bought some LVMH. This is the world's largest luxury goods company. This also had a bit of a downturn last year, not as sharply as Nike or Starbucks in share price terms, but it's a company we've long wanted to own, and we thought we were unlikely to get better events than those of last year in terms of a buying opportunity in it. We think we know a bit about the luxury goods market through our cosmetics companies, which are exposed to it, and through our drinks companies, which are exposed to it, but we had nothing in the sort of central area of designer goods in things like accessories, apparel, jewellery and watches. And so we bought a position in LVMH during the period to give us exposure to that area. And I think that's it with regard to me taking you through the events of 2020 to the fund. In terms of the effects of inflation, I don't think the size of our funds got anything much to do with it either way. It's what we own. And I would say there are two effects to talk about. One is the fundamental effect on the companies. What does it do to how they're operating? And the other one is what happens to the valuation of shares. And starting with the fundamental effects on the companies, I would say that if you get higher inflation, the best sort of companies to own are, ironically, the sort of companies that we own. Why do I say that? I mean, obviously you'd expect me to say that, I suppose, to some degree, but why do I say that? Our companies have got a return on capital employed currently of about 25% in the last year. And our investors will have seen that earlier on in my presentation. If inflation goes from where it is at the moment, sort of 1% or so, up to 10%, that's clearly an awful lot better to have a 25% return on capital than the index, which has got about 10% return on capital. Clearly, a 10% return on capital, 10% inflation means, in real terms, you're not making any money at all. So I think it's good to have high returns, capital companies. The second thing is our companies have got very big gross margins, the margins between their revenues, the sales revenues, and the cost of goods that they sell. So that they take in the ingredients and components and services, do something to turn them into something they sell, is 65%. So they make stuff for 35, sell it for 100. And the index, the same number is about 40%. So the index makes stuff for 60 and sells it for 100. Why is that a good indicator if we get inflation? I would say it's because what that gross margin, that ability to mark up is telling you the company's got good pricing power. And clearly, if there's going to be input cost inflation in terms of components, commodities, staff going into what they do, being able to pass that on is a critical part of their ability to perform. So I think fundamentally, I feel relatively comfortable in what we're doing. I feel less comfortable in valuation terms. If inflation rises, bond yields will have to rise as well. If bond yields rise, automatically, things which are, as they call them, long tail assets, more highly valued, are more adversely affected. A long bond is more affected by a rise in interest rates than a short-dated bond. And our stocks are a bit more expensive than the index. So I think in valuation terms, we'll have a hard time, is my view. I'm less concerned about that because I think the fundamentals of the company should be relatively good. I'm not to say it won't give us concerns if it occurs on the way through, because it definitely will. But the more important aspect of this, I think, is are the companies actually going to be okay? Because if we can all sort of hold our breath and wait for it to pass, as it were, the most important thing is, are the companies still there and doing what they do as well as they do it? So I would say fundamentally, I think we're okay. Valuation, more exposed. I'm not sure I need to worry about him as a CEO because he's not anymore. He's about to not be anymore, isn't he? So I can probably duck that particular part of the question. We've not invested in Amazon to date. We might be right or wrong. I mean, certainly in share price terms, you might say we've not been right. Why? And it's basically because, and I've got a slide here which hopefully you can see, the core retail e-commerce business has been barely profitable. You can look there and see, obviously, if you look back over the last few years, we've been a couple of years which have been literally unprofitable, and it's never got above sort of 2% margins. It was described by, I think it was Tweedy Brown, the rather venerable New York-based fund management business, which Warren Buffett worked for their broking arm, I think, when he first started work, as a charity for consumers funded by Wall Street. So you know, it's a big business, and it's grown an enormous amount of sales, as you can see from that slide. You know, in the last whatever we've got here, 7 years, $84 billion in sales, up to $344 billion in sales, and it's ubiquitous. You know, in terms of an awful lot of parts of the world, in terms of a delivery e-commerce business, but ain't making much money. And if Tweedy Brown are wrong, I mean, then they might be wrong. Partly it's because it's actually being funded by not just Wall Street, but actually literally being funded by another business. The bottom of the slide is Amazon Web Services, their cloud business, which is the number 2 in the world, basically, to Microsoft. And you can see there, we've got a business which has also got very fast growth in revenues, but the difference is it's got 30% margins. And really the short answer to the question is, if Mr. Bezos would float off Amazon Web Services, we'd be very interested. I mean, it'd be a really good business. But we don't particularly like the idea of owning one business that's subsidizing a barely profitable business. I mean, I'm sure it works for him as a model in terms of the whole thing, because the world buys it at the moment. But we don't. We're kind of a bit puzzled, particularly since it seems to me, when I talk to people about it, there seems to almost be an assumption that there must be some synergy between these two. Because Amazon is an e-commerce business and this is a cloud computing business, there must be some synergy. I'm not aware that there's any significant synergy between these two at all. It's just a happy coincidence that they're in the same business, basically. So we're not keen on business like that. I mean, you could apply a similar argument to why we've not owned Google, or Alphabet as it's now called. You know, it's got a terrific search-based digital advertising business, but its other businesses, which interestingly also involve a cloud business, are very unprofitable. It's kind of the other way around there. We'd really like to own the core business and not the periphery. Since COVID seems a bit of a short time period to judge our success or failure, but nonetheless, let's try and address the question. I've got a few tables here which I put up. We couldn't actually find a table which included the Scottish Mortgage Fund, which he names, but this has got the other Baillie Gifford funds in it. The reason why a Scottish Mortgage is not in the table is it's an investment trust or closed-end fund. The other Baillie Gifford funds are open-ended funds. So we've put up the table that shows us as in comparison from Citywire, as he says there, and there it is. And he's absolutely right in terms of return. There we are at the bottom of that table at the moment for performance. It's not a particularly helpful table, I think, for making conclusions out of this for a few reasons. And by the way, if we included Scottish Mortgage, it would be at the very top. It would have 351% return. So hopefully you can see there the highest return there is 308. Scottish Mortgage tops that at 351 over this period. The reasons why this is not all that helpful are, one, some of the funds that are in there for comparators are genuinely not great comparators. I mean, the multi-partner CCAV Barron Global Advantage Equity Fund is probably a very fine fund, but since its total size is £7.4 million, I think we might be playing a different game. And you could say that about the £89 million fund lower down, or the £93 million fund. Clearly, we're fishing in a different pool in terms of what we can respectively own. The other thing is, taking returns just on their own, I don't think is all that helpful. I think you need to look at what you get with the returns, what risks are you taking alongside the returns. And if you look at those Baillie Gifford funds, including Scottish Mortgage and some of the other funds which are on this table, like Discovery, 3 down, Worldwide a bit further down, International a bit further down. You know, for example, Tesla is a top 5 position in all those funds. Yeah, it's really powered their performance, and good for them. And they presumably think they're right about Tesla, and frankly, so far they are. Good for them. But it does lead to other things. If I take you on to the next table, you see here we've got the same set of funds, and now we've arranged it not on the basis of the performance over the period, but we've arranged it on the volatility over that period. So you can see hopefully in the final column, volatility. There you can see, funnily enough, we came out top with 12.2% volatility during the period. Whereas if you look at the bottom, you've got the Baillie Gifford Global Discovery at 20.5, and Scottish Mortgage would come in just ahead of that at 18.38 if it was on the table. So we're a lot less volatile, you know, and that is quite important, I think, because you know people's ability to stick with a strategy over time is quite often conditioned by how volatile what they're getting is. If we go on to the next table, you see a pretty similar picture. This is the cumulative maximum drawdown during this this period, this 5-year period. So how much, what was your worst fall in this period? And you can see we're again the best at 11.5%, whereas you can see towards the bottom here, you've got Baillie Gifford Global Discovery again at 21.4, Scottish Mortgage would come in at 16.3. We're delivering a somewhat lower return, I agree with you, but we're delivering it with a lot less volatility and a lot less drawdown. And it means, you know, I suppose colloquially, people can sleep easier they might feel they can sleep easier in their beds, which is a nice thing in itself. More importantly, they might make better decisions. I think if you own something and it's shooting the lights out and you come in suddenly and it's down 20%, how do you feel about that? Are you okay? Quite often people are not okay, and then they make decisions, even in these very good performing funds, that are injurious to them. I'm not sure it's investing at all, is it? I mean, it's something which the vast majority of people investing in it would probably struggle to tell you how it works, and which clearly has no intrinsic value. And therefore, presumably what people are doing is buying it because they think they can sell it to somebody else at a higher price. That's not investing, that's something else, that's speculating really. And the answer is I would never do it. So there we are. I mean, just as an aside, I sort of jogged back a bit into the previous question and answer actually with it. That's when I think about investing in Bitcoin. It's not investing, it's speculating. It's playing greater fool theory at the moment. Can I buy some at $52,000 or whatever it is and sell it on the Julian Robbins at $55,000 is really what's being played here. Not, I've got a view of what the intrinsic worth of Bitcoin is and it's more than $52,000. That's not the game. One of the other things though is going back into the question about the payment services companies is Bitcoin a medium of exchange? Because that was talking about crypto yuan and various other forms of currency. Are digital currencies a medium of exchange? And of course, there are different propositions in digital currencies. There are central bank digital currencies which people are talking about. There's cryptocurrencies such as Bitcoin and so on, which people are talking about. At the moment, my guess is that most of the the cryptocurrencies out there, like Bitcoin, fail one of the essential tests of a medium of exchange. So I'm not sure they can gain great currency as a great sort of foothold as a currency at the moment. And that is the certainty of value. You know, if I owe you, Ian, $52,000 and I say, Ian, would you mind accepting 1 Bitcoin? And you go, oh yeah, that's all right then, Terry. What we may find in an hour or two's time is I paid you much too much or much too little. And that's kind of, and I know ordinary currencies shift around a bit as well, but not that much they don't. And so, you know, the certainty of value, I think, is a problem at the moment for these in terms of a medium of exchange. I'm going to dispute whether it is of great importance to the long-term investor, because I think I could disappear and the companies that we invest in will still be going on. As I've said several times, I'd like to feel that my passing would lead to such a catastrophe that things like Microsoft and so on would cease business as a result. But I've got a feeling it won't happen. So I think the underlying investments will be absolutely fine. Yes, of course, there's a succession plan in place. I mean, the first line of defence in terms of succession is Jay Robbins, who's on this Q&A with us. Julian and I first worked together I've got to get this right now, 35 years ago, I think, this year. So we know each other pretty well. If you get a letter from me by email, which usually my letters to you begin, "Dear fellow investor." If this one just says "Dear investors," it's a letter I've already written. And I won't be a fellow investor at the time of the time that it reaches you. I'll have moved into a different status, and it will tell you that Julian is taking over, and that I think you should all remain completely calm, because the companies will still be the same companies the next day. In fact, I've got a horrible thought he's going to be better at it. And but the good news is, unless my views on the afterlife are dramatically wrong, I won't be able to see it. So I think you'll be absolutely fine. Anyway, in the last couple of years, I can add to this now. So that would have been my, as you say, my bog standard answer for some time, I think, in terms of this. We now, as a result of further recruitment in the firm and new products that we've launched in the firm, have taken on new colleagues in the last few years. And I would say some of those colleagues certainly show the kind of form at the moment, which I think might make them worthy successors in due course. The standing joke at the moment is Julian may become the Prince Charles of Fundsmith. I may, like her Madge, stagger on for an improbable amount of time, and one of the Prince Williams may step forward at the appointed moment. Who knows? And Julian seems to regard this with at least apparent humour. So yeah, I think we've got it very, very well covered. I think the team is, I think they're excellent. And I have a plan, although it requires a hell of a lot of work, which is yet to be accomplished in terms of things like tax structures and stuff like that, which is not sort of trick cycling, but just to ensure that we don't cause an event where we give somebody something and they end up with an enormous tax bill accidentally as a result, where I want to take the majority of what I own in the firm and pass it on to other people in the firm in due course. I don't think that it's a viable structure for this firm for the day when I'm not here, for whatever reason, for me to still own the majority of the firm, or for my heirs and causes and so on to own the majority of the firm. I think the people who work in the firm have to own the majority of the firm, and I firmly intend to get it to them, basically. Having said that, it's easier said than done, but I am working on it as a means over time to ensure that the majority of the firm one day will remain with the people who work in the firm. I think that's a healthy thing.
Right, thank you very much for that, and very insightful indeed. And if I maybe can just add a comment from an investor behavior point of view. I mean, Terry showed those kind of funds that gave phenomenal returns over 5 years, but we've all seen, if you've got highly volatile funds, even if they give good returns, very few clients actually stick to them. And that's what we like about the Fundsmith fund. You still get very good, solid returns with a lot less volatility, so more likely that your clients will actually remain invested to get those kind of returns. Fascinating. Before we break for tea, I actually just want to hand back to Dan very quickly. Dan and his team from Excel Academy, they're responsible for all the technical workings behind the scene. And believe me, it's a mammoth task. We could just give our audience some feeling as to what's going on. We've got a couple of WhatsApp groups running between the technical teams, Dan team, Tanya's team. We've got our own marketing team in the background as well. And the speed that those messages go through is probably about 10 messages every minute. Look at the screen, look at the layout, look at the lightning, all the people there. Can you hear them? Can you hear me? So it's phenomenal what's going on. And Dan, you're the main man behind everything. You're doing absolutely phenomenal work. And I believe this year, like last year, you've got a gift again for the audience, but I'll leave that in your hands to explain to them briefly what it is. Thanks.
Great stuff. Thank you, Eugene. Yeah, absolutely. So last year, we actually hosted a free Excel masterclass, because in addition to hosting these Zoom events since the beginning of lockdown, we've actually been running an Excel training business called Excel Academy since 2014, training tens of thousands of people to work smarter on Excel. So as a free gift to you, as an attendee of the BCI conference this year, we are once again hosting a free Excel masterclass. It's on Zoom. It's next Tuesday, 1st of June at 9 o'clock South African time. I'll post all the details into the chat section, including the link to register. And you can look forward to learning a whole lot of practical and relevant insights, techniques, tips, tricks, shortcuts that you can apply into your day-to-day work in Excel immediately. And best of all, you actually don't need to worry if you consider yourself a complete beginner or quite an experienced Excel ninja. You're guaranteed to learn some really valuable tips and insights. So I'll post that into the chat box. And Eugene, thank you for the opportunity. Are we ready to go over to the tea break for 20 minutes?
Yes, we can. Dan, thank you very much for that. I'm definitely going to take you up on this offer this year. I'm not going to miss it again. And I mean, very relevant, especially to what we do on a day-to-day basis. We are going to break now for tea. We ask you all to be back at 10 past 11, 11:10 sharp. And then we'll continue with the rest of the session. So grab yourself a nice warm cup of coffee, a snack or two, and we see you all back here at 11 or 10 past 11. Thank you so much. Right, we'll just give it a couple of more seconds as for everybody to return. We'll get going in just a bit. Right, I think we can actually start. Global Investment Managers' views are next, and here to introduce the panel is Nadine van Taak, Senior Investment Consultant at Analytics Consulting. Nadine, thank you so much for joining us. Always great to have you. Analytics Consulting was one of the first independent investment consulting firms in the industry and has been in business for more than 15 years. Their primary focus is providing independent consulting services to Category 2 investment managers. And aside from this and providing leading local and offshore portfolio construction, they also partner with their clients in providing additional strategies that will grow your business. And that's what sets them apart from a lot of the competitors out there. Nadine, thank you so much again for joining us. Looking forward to your panel and topic which you will introduce. Thank you. Over to you.
Thanks, Eugene. Good morning, all, and thank you for that kind introduction, Eugene. And thanks for the opportunity to take part in this conference. With us today, we've got Henry Boucher. He's the Deputy Chief Investment Officer at Saracen & Partners. Henry will share with us some of his views on why they believe global investments need to become more purposeful and how they put that in practice at Saracens. After Henry, Alex Lyle, Senior Portfolio Manager at Columbia Threadneedle, will share with us their views on why they believe discount rates will remain low. Both of these discussion points are very topical at the moment, and we look forward to hear your views. Can I please just remind everybody that if you do have a question, please pose it in the question and answer section. If we don't get to them during this section, we'll just carry it over to the breakaway session later today. With that, I'm going to hand over to you, Henry.
Nadine, thank you so much. I'm going to share my screen. As you say, my topic is a little unusual. I hope that everyone is familiar to some extent with Saracen & Partners. We are a medium-sized boutique asset manager. We've been involved with South Africa and had many South African clients for the last 20 years, for which we're very grateful. What is a bit unusual about Saracen & Partners is not our global presence or indeed the assets we manage, it's who we manage them for. And so we have clients who are private investors, institutions all around the world, but the biggest section of our client base is charities. And many of these organizations are leaders in the field of considering social ills or environmental challenges. And over the last few decades, we have worked in collaboration with them to become experts in their concerns. Now, of course, today that is highly topical and everyone is considering these factors, but I wanted to talk to you a little bit more, not just about the current trends, if you like, in ESG, but a little bit more about what it means at the heart to be a responsible investor and to think about the future. So I'm going to come back to Auguste Rodin, who produced this famous sculpture, which sits today in the Musée Rodin in Paris. And I'm going to talk a bit more about the purpose of business. And purpose is a slightly strange word because, of course, we all do everything with purpose. It's not that investment is accidental in some way. But I want to really go into the meaning of it and why it's going to have such a profound impact on investment in the future. This isn't a cuddly knit your own sandals sort of hippie type movement. This is something that is fundamental to the way that investments will perform in the future. So our clients today give us mandates that are all about the money. Every mandate typically has a benchmark. Clients are looking for a report that says how much has the value, the financial value of my investment gone up. That's the baseline. But things are changing. Increasingly, we as investors all say, of course, we integrate ESG. But we're perhaps a little bit less clear on why, or indeed how we integrate ESG. There is a profusion of very confusing data, most of it very inaccurate, quite simply because companies don't actually offer very much information on their ESG performance. So a lot of us are resourcing to buying in services from outside, from MSCI or other big data providers, who effectively provide a little light. It's a little green light that says this investment's okay. Now, that's not enough as we move forward, as we all know. And over the next period, we're going to see a dramatic change in regulation. We're going to see the SFDR, the Sustainable Financial Disclosure Requirement, becoming more and more influential around the world. It came into place in the European Union on the 10th of March, but the UK has already committed that it will have at least equivalent legislation, and an increasing number of other countries around the world, I think including South Africa, indicating that they are looking at a taxonomy or some form of sustainable financial disclosure regulation. So the whole process is going to be ratcheting up over time, but it's getting to the heart of an underlying problem. And this issue, we'll all get used to this phrase much more, is double materiality. Not the single materiality of it's all about the money, just the financial capital. It's about this link between financial capital on the one hand and natural and social capital on the other. Now, these two basically are often in conflict. If you are managing a business, it's all too easy to look to make a profit and forget about the consequences, say, of climate change or pollution or what happens to your product at the end of its life. That's not your problem, that's someone else's problem to deal with. So there is an inherent conflict. And often, if you are going to take account of natural and social capital, you are going to end up with a lower return on financial capital. But this is a knot. You cannot pull one rope and not pull the other one. And that's really where double materiality, as it ratchets up over time, is going to have a bigger and bigger impact on your financial capital returns. And therefore, they can't be considered in isolation. They can no longer be considered with the inadequate information we currently have today. So one of the things that we've been doing at Saracen & Partners and many other investors are doing is really engaging with both the companies themselves, but also with policymakers to change the environment. And we're going to see a massive shift, for instance, in accounting standards, in audit practices, in the way that companies communicate what they do, and not just in financial terms, but also measuring their social and natural capital impacts. Now, you're going to see some of that perhaps in the next few days. We have a vote coming up at ExxonMobil tomorrow, which is going to be fascinating, because this is an attempt by investors to change the board of Exxon from those who, to be honest, have been pretty careless in their attitude towards climate change up until now, to begin to introduce directors who will actually begin to think about climate change and manage the company in that context. So change is happening. There's an underlying conflict of interest. It's about double materiality, but it's also in its heart about purpose. Now, what is the profit of, or rather, what is the purpose of business if it's not about profit? Now, this is where I'm going to turn to some academic support and help. The British Academy is populated by an enormous rank of some of the world's top philosophers, and they spent many, many weeks and months thinking about the purpose of business, and they came up with a disarmingly simple definition of what business is for. And they basically said that the purpose of business is to solve the problems of people and planet profitably, but crucially, not profit from causing problems. Now, it's in this definition, in this fundamental basic proposition, that the change that we are seeing is coming about, identifying companies that are profiting from causing problems. It isn't necessarily about trying to identify the good guys. You won't find some unique business that employs, hundreds of thousands of people, educates lots of kids, saves billions of liters of water. Those sorts of propositions are unlikely. Actually, we have to look at each business for what it does. It serves the needs of its customers, it employs people, it's part of its community, it organizes, it pays taxes, it does lots of good things. You don't have to pick out the good stuff. The key point is this thing about profiting from causing problems. Now, Rodin produced over 70 models of the thinker in his life, but he never gave any explanation as to what the thinker was actually thinking about, except perhaps in the very first image that he produced. The first of the thinkers, as you can see here, was actually depicted on a model he created of the gates of hell. Now, the reason I think this is relevant is when we start to look at the challenges that we have today. Perhaps climate change has been rather misnamed as a relatively gentle symptom of the disease. The actual underlying problem is that we are covering the world in a blanket of pollution, and we're going to have to stop doing that. You can see that graphically when you look just simply at the demographics that we face today. This is the world population over the last 50 years. You can see that in 1970, we had about 3.5 billion people. And today we have about nearly 8 billion people. And over that 50 years, our environmental footprint has been getting bigger and bigger. We've been consuming more stuff to the point that we're now using the resources of nearly 2 planets. And we can't all possibly get to this point where we all live the American dream, because if we did, we'd need 8 planets. So we're in this really impossible problem that we have to resolve together. And we're beginning to do that by recognizing climate change, but we're in the early stages of a much more fundamental shift in the way that we consume and the way that our industries produce goods. It's very clear that to return to balance, we're going to have to change consumption trends really fundamentally. We're going to need an awful lot less fossil fuels, vehicles, plastic bottles, meat and dairy, wild fish, building materials, household products, vegetable oils, clothing, a lot less stuff. The material side of the equation must shrink. And instead, the economy will become dominated by intangible areas, services, things like data, savings and insurance, online services, health services, recycling and repair services, renewable energy, experiences. These are the parts of the economy which can grow in the future. And I don't have to tell you this because the stock market already has. If you look at the chart on the left, what I'm showing is the world index, the red line going back to before the financial crisis. And you can see that since then, the world stock market's done pretty well, up 142%. But the bit that's done best, as we all know, is information technology. The virtual world is already performing incredibly well. And the material world, in the form particularly, say, of fossil fuel energy, is still below today where it was before the financial crisis. Now, it's not just fossil fuel energy. Before you will jump to the conclusion, right, I need to be in the future, let's all go and buy renewable energy stocks. On the right-hand chart, I've also, just for your interest, shown you an ETF, which represents obviously a clean energy index. The red line, you can see that whilst it's doubled in the last year on this sort of speculative bubble that we've seen, it's on its way back down again now, you would have lost an awful lot of money by investing in renewable energy over that same time period. For the very simple reason that this is a highly competitive industry and the prices of renewable energy are falling every day. It's not an easy place to make money. So there's something pretty fundamental going on here. What we have is a massive shift in the way that industry used to make money to the way that it will make money in the future. And it's not just about the tech, it's actually something much more fundamental. It's not just a positive of new companies making money, It's also the old companies, many of which we still invest in passively or not knowingly, which are losing their ability to make money in the way they did in the future. And instead of making more and more stuff every year, they're going to be making less and less. It's an incredibly important investment issue to understand if you're investing for the next decade and beyond. Now, I'm not saying it's going to happen quickly. It's taken a very, very long time for us all to adjust to climate change. If we think back to when climate change was first mooted back in 1992 at the United Nations Rio Earth Summit, it took until 2006 before G7 leaders started to talk about this, and the G20 when the Stern Review on the economics of climate change was published. And then we saw a bit of an agreement at COP21 in Paris, but to be honest, it was a bit of a fudge. And so this year, we're really hoping for something more fundamental at COP26 in Glasgow in November. And at that point, we are going to see some much more fundamental action by governments. And we've seen that heralded in the Biden summit that we saw a few weeks ago on Earth Day, when so many countries around the world have now pledged to reach net zero by 2050. Action is being taken, and it's really substantial action. So we'll see that follow through into other issues. We've got massive problems with land. We've wiped out nearly 70% of all of the wild animal population in the last 50 years. Biodiversity losses is also being tackled at another COP conference in October. The circular economy, the plastic issues, the end of life issues of products, the water issues, the air quality issues. And very sadly, nearly 9 million people have now died from COVID, but every year 4 million or 4.5 million die from problems of air pollution. So these really big issues are not just going to hang around for 30 or 40 years to be solved. They're all going to be solved in the next decade. And we're going to see a massive change following on from climate change as everyone begins to embrace double materiality. It's not just all about the money. So the purpose of business is to solve the problems of people and planet profitably, but not to profit from causing problems. And in the short term, there is this conflict of interest, and we have to recognize that, and we have to look at the way that financial capital is generating returns with, not necessarily rose-tinted spectacles. That conflict will persist, and it will need to be managed carefully. But in the long term, I think we're all aligned around the way that business needs to operate. It will no longer be wrapping the world in a blanket of pollution. And that really comes back to how we think at Saracen and Partners, and why our clients are so aligned with our thought process, is that, excuse me, we can be brave. We don't have to invest in oil companies if we don't want to. We don't have to invest in all of those businesses on the left-hand side of the seesaw if we can see that thematically they're not going to make money in the long term. And we can positively invest sustainably in a huge range of companies. We don't just have to pick out water companies or things that look like they're special. Actually, it's about just very simply thinking about the costs of causing problems. And then finally, getting involved in that Exxon vote and changing companies for the better through voting. Now, I think my time is up, and Nadine, I'll hand back to you. Thanks very much.
Alex, over to you.
Thank you, and good morning to you all. And I'm delighted to have a chance to talk to you this morning, even if it's only a virtual meeting. My subject is keeping faith in low discount rates and what impact that will have, if they do stay low, on asset markets. So first of all, if we go on to the first slide, keeping faith in low discount rates. Do we believe they will stay low? Quick answer is we think discount rates will remain at the current low levels for a fair period of time. And as I said, that is has crucial impact on all asset markets. So why do we think that? Well, first of all, we think inflation will be transitory. We don't think it will be a medium to long-term problem. Certainly short term, we are seeing inflation spikes. We are seeing rises due to things like capacity loss due to COVID, bottlenecks in supply chains, increased costs from COVID. Restaurants and so on are having to employ new staff, extra staff, because it's only waitress service that's allowed and things like that. We've heard a lot about environment recently, and clearly that will add to costs for companies. So that can push up inflation. And raw material prices are up a long way because of the fiscal packages, or partly because of the fiscal packages that governments are introducing. So certainly short-term risks, but medium term, we don't believe inflation will stay high. We think it'll come back down again because capacity can be restored again when people return to normality. The long-term deflationary forces we've had for some time are still out there. Things like price comparison on the internet. We all know the price of everything. Cutting out the middleman. We're doing things ourselves nowadays rather than using agents. They are all still present and will keep inflation down. And there are, I think, some very big real changes in productivity in the pipelines that again will free up resources. Things like driverless cars, things like automatic checkout at supermarkets will free up labor and keep costs down. So if we look over at the right-hand side of the slide, sorry, going back this on the previous slide, please. If we look at the right-hand side, that is inflation in major economies over the last 20 years. You can see it's really been pretty much in a range of sort of 1 to 2.5%. And we think inflation will return to those sorts of levels. So we think inflation will remain low. Secondly, on discount rates, on the next slide, we believe that central authorities, central banks will keep their feet on the throttle to get economies going. And keeping their feet on the throttle involves A, keeping interest rates down at very low levels, roughly zero at the moment. And on the right-hand side, you can see there that market expectations for rises in interest rates in the US are just for one small 25 basis point rise by the end of next year. Very little. And we think that central bank quantitative easing, that slide on the left, huge, great plans for QE packages, much bigger than we saw in the global financial crisis, will continue. And that buying up of bonds will keep bond yields low. So we, on the next slide, we expect bond yields to remain low in that environment, i.e. the discount rate will remain low. And if we look on the left there, you can see bond yields, 10-year bonds in major economies. And they've spiked up a little bit recently with better news on recovery, but basically they're down to very low levels by historical standards. So what and bond yields basically are the discount rate. So we think that will remain low, despite being quite an attractive background. It's just very low and can't really go any lower. So what do we think the implications of low discount rates are? Well, first of all, for bond investors, we don't think bonds are very attractive. As I said, we're not expecting yields to rise much from here, but there's just not much value in yields at those very low levels. Returns will, we believe, be small. Within bonds, there's some more attractive areas. We think US treasuries are some of the better looking government bonds. We think peripheral Europe, i.e. some of the slightly higher yielding areas, do offer better value. And also within bonds, again, slightly higher yielding, we think that high yield corporate bonds, investment grade corporate bonds, are better on the value chain than government bonds. But by and large, bond markets are already reflecting the low discount rate world, so not much to go for there. What are the other implications of low discount rates? First of all, we think it means healthy economic growth. And then on the next slide, we explore that a bit further. You've got low discount rates, i.e. borrowing costs are low for consumers, for companies, so borrowing can go up, and consumers have more disposable income after they pay their interest bill, so they can afford to spend a bit more. But on top of that, we've got governments stoking recoveries. Fiscal policy is very loose, and clearly Biden in the US is leading that charge with his huge fiscal packages. He started off with a $1.9 trillion COVID recovery package. Then he announced on top of that a $2.25 trillion infrastructure package, and more recently, just short of another $2 trillion families package. These are massive fiscal boosts, which will increase government expenditure and debt, certainly. But it will keep economies pushing ahead. The authorities are very keen not to risk economies slipping back. It's a very different environment from the global financial crisis, when the talk was all of austerity and making sure debt levels were kept under control. This time, you don't hear about austerity. It is large fiscal packages. So what are the implications of that? We think, if we look on the next slide, it means a sharp, healthy recovery. And you can see on the left, those are US retail sales and important corporate surveys. The PMIs are showing a real big boost in the short term. We think it is definitely a V-shaped recovery. And it wasn't long ago people were talking about L-shaped recoveries, U-shaped recoveries, W-shaped recoveries. We think it's a good, healthy V-shaped recovery. And expectations for growth have risen enormously just in the last few months. And on the right there, those bars, those show market consensus expectations for US GDP. And you can see just in January, the market was expecting just under a 4% growth in GDP in the US this year. Now the market is expecting that to be north of 6%, a huge increase in expectations over a few months. In the UK, it's a very similar picture. The Bank of England forecast 5% GDP in February. It's now forecasting 7.25%. So a very impressive upgrade to growth expectations. And one of the factors that's really helped growth on the next slide is vaccine news. And that clearly has been very helpful. On the left, we can see UK and US COVID cases well down from the spike level we saw sort of at the end of last year. And the vaccine news has been good. We've all known about Oxford University AstraZeneca jab. We've all known about BioNTech and Pfizer jab. Moderna came along a bit back now, but then more recently we've got the Novavax one, which looks very effective. We've got the Johnson & Johnson one, which looks good, and many others. And the more vaccines that are approved means the faster rollouts can happen. And that's such a crucial part to getting economies going again. So it looks like we're going to have healthy growth, partly helped by that low discount rate. What does that mean for equities? If we roll the slide on, with equities, we have low cost of capital, which is helpful. We've got strong recoveries. And on top of that, we have got very good corporate results being announced. Companies have done a very good job in protecting profits in the pandemic. And the bars on the left show we've basically just about finished the first quarter of this year reporting season, and earnings have come in 22% ahead of market expectations. That is massively ahead of what the market was thinking only very recently. And on the right, you can see that 86% of companies have reported ahead of expectations, a very high percentage. And that's the market overall. Some companies have been having a fantastic time because they were in the right place for modern trends, and COVID has accelerated those trends. So companies like, if we look at Amazon, Apple, Facebook, Microsoft, and Alphabet combined, their profits Q1 this year compared to Q1 last year are up over 100%. So some very healthy corporate results coming through. And that means dividends can go up more. It means buybacks can go up more because companies are generating more profit. So equities are our most favored area for investment. They're not looking desperately cheap, but the wind, we think, is still behind them. The environment is healthy. And within equities, if we look at the next slide, we think you really want to concentrate on the secular trends that are taking place. Very important changes in the way things are done by both consumers and companies, and you want to back those rather than people with yesterday's business model. So things like decarbonisation, we've heard from Henry a lot about responsible investing. We agree that is an area where there will be much more interest. So things like that, digitization, digital controls, automation, cloud computing is much more efficient than in-house capability. Back the people that are leading that. Medtech, Medtronic is primarily a cardiac procedures firm. Edwards, again, it's in heart valves, very important areas with a lot of growth. On the right side, payments, cashless continues, demographic change, Chinese wealth growth. Ping An is an insurance company really benefiting from the huge increase in wealth in places like China. But having said that, bottom right-hand side, we do think that this value pickup in the short term that we've seen may continue for a bit longer. So worth focusing still for a little bit longer on some of those more value-orientated, more cyclical reopening of economy stocks, things like US railroads or Disney, which clearly is opening up again for business, and people are very keen to get out and enjoy life again, having been locked up for some time. So we like equities, we like for the medium to long term, backing the important trends taking place in markets. Finally, if we look at what low discount rates mean for property, we think clearly a low discount rate is beneficial. Low funding costs help the industry enormously. And again, there are some very interesting areas within property that you want to back. Things like industrial, which is these days, that is the logistics behind all the online trade we're doing, storage, distribution, etc. Residential in some areas. Vonovia is a German company. They've seen a lot of immigration in Germany that needs housing. Equity, lifestyle properties does small units in the US, benefiting from an aging population, trading down on size of homes. On the right, towers and data centers. Digital realty is data centers for cloud computing. Towers, internet and Wi-Fi communications, and so on. So there are good areas for investment that we like, but at the same time, we know retail is going through a difficult patch. We're not really sure about the implication for offices of COVID. So overall, we think property is neutral. Reasonable value, but some issues. So my final slide, in conclusion, we think that discount rates will remain low for some time. We think inflation will remain low. We think we'll see healthy recoveries. And in that environment, fixed income is our least favored area. Property, as I've said, 50-50, we're neutral, and equities are the area we think are most interesting, particularly the stronger economies like the US and Asia, and the companies benefiting from the strong trends taking place in the way we do things. Thank you very much.
Thank you, Alex. I see we've got 2 minutes left, and I've got one question from the audience, which I'm going to pose to you, Henry. Tian Fourie asks, can you comment on the impact of food production and agriculture and fossil fuel and mining often get labeled as the biggest polluters, yet our diets are by far the biggest polluter? What's your comments on that?
Right, I mean, the issue of land use is really what we're talking about. And we don't just use land to grow food, unfortunately. We use it often to justify the use of the land. But if you look at, for instance, the US corn crop, 70% of the US corn crop is used for industrial purposes, they call it. And actually that means creating biofuel, which is blended with gasoline. So we really don't need to be growing fuel that we burn in our cars. So I think the issue of land use is one that's complex, and it is I think, as the question is saying, it's much more complicated than it appears on the surface. It's about the use of land for things that are not about food that is really the problem.
Thanks, Henry. We are running out of time. I'm very excited to have further discussions with you in the breakaway sessions later today. Just to remind everybody, the links to these sessions will be posted later during the course of the morning, and please join us for further questions. So thank you very much, Henry and Alex, for your contribution.
Thanks, Nadine.
Many thanks, Henry and Alex. That was very interesting presentations indeed. And I must congratulate our moderators and presenters for your keeping to the time limits. I know it's a big task, a short space of time to convey a big message. You're all doing absolutely well, so thank you so much for that. Right, joining us now is Tavanga's colleague and Managing Director of Boutique Investment Partners, Pierre de Klerk. Pierre, thank you very much for joining us as well. And he's here to introduce our next panel and topic on regional global equity. Many thanks, Pierre.
Thank you very much, Eugene. We had some great presentations so far this morning, really enjoyable. The one aspect we didn't hear more about, which I hope we did, was Terry Smith's views on the afterlife, but maybe we'll hear more about that next year. That could be interesting. The next session is all about emerging markets. We look forward to that. Our business, Boutique Investment Partners, have been keen investors in emerging markets and in Africa over the last number of years. So we feel a bit cheated by COVID. If not a case of paradise lost, then a case of paradise postponed is what it feels like. But we look forward to the insights that the speakers will give us. The first speaker up will be Fungai Tarira from Rudy Arias, the Africa Equity Managers. And Fungai will talk about how sad it is that in cases of crisis like COVID have shown us, Africa is often left by the rest of the world and ignored, and so also her opportunities. So it will be interesting to hear what he says. Following Fungai will be Paul Neethling from Coronation. Coronation have built a very substantial emerging markets proposition over the last number of years. His topic is emerging markets in the year of the ox. To me, it feels like the year of the virus again, but not so in China. And he will be speaking about how and why China has coped with COVID-19 so well and what the implications are for their market and their economy, among other things. The last speaker will be Ian Beattie from Net Group, and he's got some fascinating graphs. Important point that he makes is that emerging markets is not a static universe. It has changed dramatically over the last 2 to 3 decades, and we should not make the mistake to think that it remains static. He also shows the famous graph of 2,000 years of economic history in one graph. That's always good to see. And then he shows a few graphs about South African performance relative to other emerging markets, which really brings tears to our one's eyes as a South African, at least with the view on the recent past, but hopefully the future will be different. So straight on to Fungai, and I think we can make the transitions pretty automatic between the speakers. When you're done, you can just hand over to Paul. Fungai, thank you very much.
Thank you, Pierre, for the introduction, and also thank you to Robert and the team at BCI for the opportunity to speak to the audience today. It's quite auspicious, I think, and knowing how BCI works, I think they actually had it in their planning. I'm here to talk about investing in the rest of the African continent, and it just so happens to be taking place on Africa Day. So I'll start off by wishing you all a happy Africa Day, the 25th of May, and then I'll tell you about some of the things that are particularly exciting about the African continent that equity investors, I think, tend to miss out on quite a lot of the times because of their attention being picked up elsewhere. So the title of the presentation is African Memorabilia. And the issue really is just to say, these are good assets. They come from good times, but more often than not, people just forget how that actually used to work. So I'll take you through the presentation. You know, if we use sport is almost always an easy sort of analogy to give to many investment scenarios or things that are actually taking place in the investment universe. So today I sort of came up with boxing, and for fans of that sport, they can go back to a time when you had some very storied fighters, high skill levels that used to come through and have these, up until today, famous bouts, which were long, 15 rounds, hard slogging, and it was actually just a sight to watch for anyone who was really into the sport. But like anything else, along came the modern era, things kind of changed. Apart from the boxes getting smaller, you also had different modes actually starting to come through and different ways of actually participating in the sport. And some people sort of look back and have the nostalgia and say, well, those were the better times back in the days, and the modern era doesn't offer us what we need. Others will look at it and say, look, it's evolution of the sport. We really need to take this in a different direction. But I think what no one disputes is the fact that the value that the olden days really brought to the sport is quite clear and continues to show even in this day. Similarly, if you look at markets, stock market investors around the world have gone through phases. And over the last 5 or 6 years, we've seen a phase where people sort of look at the old sectors or the old economy parts of the market, and they've decided to move away from those kinds of businesses in transportation, manufacturing, food production, all those sorts of things. Investors have been looking at that as old hat and saying, well, we'd like something a little more juicy, a little more snazzy. And instead, people have been moving more towards new technology or new world sort of markets and ideas to sort of put into their portfolios. And over that 5 to 6 year sort of period, that has actually worked out reasonably well in some cases. In other cases, well, the trucks didn't start, even if they were pushed down the hill to sort of get them going. But the thrust is clear to sort of move more into the new economy part of the world to try and get that going. Does that mean that the old economy offers no value to anyone who's actually investing? We'd beg to differ. And if we see what happened with COVID, certainly as the downturn came through and the lockdowns that followed on from that, thanks to COVID, a lot of global growth actually slowed down quite dramatically in 2020. You've all seen the numbers, I need not labor them. And the point is, as the economy sort of slowed down, it became a real question to say, how do we recover coming from where we are, and how does this actually help? And a lot of people sort of look at the African continent and say, well, the monetary stimulus and the fiscal responses have not been as large as other parts of the world. So can these countries make it out of COVID? And by extension, can the companies operating in these environments continue to produce profits for their shareholders and do particularly well? So when COVID hit, you're all familiar with the movements in this graph. Sort of first quarter of last year was when COVID sort of hit. Markets responded negatively to that. Correlations were actually quite high. And then it's all really been about seeing who recovers first, who recovers strongest coming out of that calamity that we witnessed as a globe. And the white line there is what Africa has done coming out of that crisis. Now you'll notice it wasn't as badly as affected as some of the other markets that are out there, but also the recovery hasn't been as strong as we've seen in other markets. And our argument is this is actually incorrect. There is a lot of value that is being presented by African businesses, but for a variety of reasons, many investors, global investors, have not really cottoned on to this, preferring to focus their attention on other parts of the world. What state are these African businesses in, you might be wondering? Well, if you look at this chart, it's got a lot of lines and colors, but the best thing to just sort of understand is the red dot shows you where the metrics are now versus the orange, which is the highest that the metric has hit over the last 10 years. The gray is the lowest that it has hit over the last 10 years. And the blue is basically the 10-year average. So we're just trying to see where these metrics are through the cycle, or at least over time, to sort of get a sense of where we are in the cycle of the specific metric. And here we're looking at operating margins. So the world went through its largest pandemic in recent memory, certainly its largest synchronized lockdowns and closures of businesses, and African businesses still managed to earn operating margins that are not the lowest that they've seen in 10 years. You know, speaking to managers of companies in places like Egypt, they'll tell you that COVID was bad, or the lockdowns came through and they were bad. But at the same time, they were not the worst thing that they've seen in the last 10 years. They've been through the Arab Spring. They've been through significant devaluation of their currencies. They've experienced so many other things. So when it came to dealing with COVID, didn't make it pleasant, didn't make it easy, but they certainly had ways in which they could actually handle all the issues that were coming up during that time. So operating margins for many African countries have maintained, despite these lockdowns running for almost a quarter of the year in 2021. Even if you look at the returns on equity, hovering near average. And again, this is coming out of one of the toughest periods ever, where profits have actually been negatively affected. Companies are still managing to turn in some pretty decent returns on equity, and we expect this number to only improve as we go forward. A large component of African markets and African indices is actually made up of banks, insurance, and financial companies. And many of those types of businesses were forced to take on provisions in the wake of the lockdowns and of the virus, which negatively impacted their profitability, or at least their reported profits. In time, as those provisions unwind, we think it'll come back down to profitability, and it'll boost the margins in those businesses. And that increased profitability ought to see returns on equity increase as well. And another interesting issue is the fact that many companies deleveraged during that time because they wanted to sort of wait and see, or at least be prepared for anything that could happen in their operating environment as they move on from there. That deleveraging also put some downward pressure on ROEs, which we think will actually recover as we go forward. And when you look at the ratings on the markets, a lot of African stocks are still trading around their 10-year average, despite having shown this resilience and having the benefit of a low base out of 2020, and also new growth opportunities as they go forward to show this rapid increase in earnings. So we think that a lot of surprises, upward surprises, are likely to come through in 2021 and in 2022 as companies come through from the disruption that was caused by COVID. And for one to actually go out and buy companies with reasonably resilient earnings, reasonable visibility on how they'll turn out, paying something like 11 times is not something that is the end of the world. I think compared to some of the other indices that you see there, that's actually a pretty reasonable rating. And the same thing goes when you look at price to book. Just to sort of make the same point, for a lot of the banks that we look at, they're trading below 1 times price to book. And the quality of the books, of the loan books, or the assets that they actually have on their balance sheet is actually impeccable. And in some cases, the best that they've seen in a very long time. And yet they're still trading at less than 1 times book. So the journey from where they are now only to 1 times book, we think offers a lot of reward for people who invest in those stocks at this point in time. And lastly, just sort of looking at dividend yields, you'll see again that African dividend yields have maintained. And I think that speaks to the strength of the cash flow generation that the companies have managed throughout this time, despite all the challenges that were taking place. And again, regulators of banks came through and prohibited them from paying out their dividends in 2020 in an effort to preserve capital. So that actually took away from the yield that was actually available from African stocks. Many of the banks are already talking about doing a double dividend or doing a special dividend in 2021 or in 2022 as the regulations loosen up and they're allowed to reduce some of the capital that they have on their balance sheets, because currently they're overcapitalized for the kinds of businesses that they actually are running. So you sort of take that backdrop for the African continent and you compare it to what is taking place in the rest of the world. We think, at least from where we're sitting, that the link between price and valuation in many other markets has become a lot more tenuous than what you actually find in African markets. And a lot of people at this conference have been talking about the impact or the effect of inflation and how that actually comes to play. A lot of African countries, it's tough when you're going through it, but the experience steels you for what comes. You'll find that a lot of African countries are well rehearsed in terms of dealing with rapidly rising inflation, and a lot of the companies in our universe really know how to handle themselves. But basically, pricing power and their ability to hedge parts of their balance sheet continue to protect them as and when that inflation actually comes through. So should that rear its head and become an issue, we think that a lot of the businesses that we look at can continue to take care of themselves reasonably well as inflation actually rises. The biggest reason why African stocks, in our minds, have not really rallied or come out of the crisis as well as other markets, it's basically an issue of flows. A lot of global flows have preferred to go into other markets, and typically larger markets. So a lot of the cheap or free money coming into the Western part of the globe, that has actually found its way into mega caps, which are prevalent in many other parts of the world, but not really in Africa. There is liquidity. There are sizable businesses for people to invest in, but certainly maybe not if you're 100 or 300 or $500 billion fund and you're looking for some exposure to some equity. Africa is probably not where you would actually find that exposure. But for many other funds, which are $3 billion, $1 billion or a lot less, there's lots of room for opportunity there, and it can be successfully acted on without any significant issues. The other issue is, I think many of the glamorous sectors that we see on some of the other exchanges don't really exist on the African continent. So simply because of that rush towards renewable energy and recycling and biotech and all these other interesting sectors has also seen investors leave out some of the great opportunities on the African continent. But that speaks to share price. It speaks nothing about the health of the underlying businesses, the successes the management teams have had in navigating the challenges that they actually have, and more so the long-term prospects that these businesses actually have, which we think are particularly bright, especially if you factor in the low base that 2020 actually puts in the growth numbers. Where are we finding opportunities? It's in areas where financial inclusion continues to accelerate. And remember that there's been convergence between banks and telcos and fintech businesses. So all of those kinds of businesses are furthering financial inclusion across the continent, coming up with innovative products to try and get more of the unbanked or unserviced population in terms of financial services into the system and into the fold. A nice flow through from that is obviously more of the money comes into the formal sector, and with that, the recorded statistics of the general economy and many other parts of the economy also start to grow. Education is a problem. There isn't enough, or there aren't enough educational facilities in many of the countries across the continent, but many entrepreneurs are actually out there looking at that as an opportunity, and they're successfully providing a lot of education services in new sort of setups, which we can access because thankfully many of them are actually getting listed. So we think that while global liquidity has not sloshed over into African markets, pushing those prices, stressing out the link between price and valuation, there are plenty of opportunities for anyone who is patient and shopping at this point in time to get into some really high quality businesses, which we think will do well for them as time goes on. And here's just some of the examples of the high quality businesses that we come across. We have Sira in Egypt. They basically provide education for everything from kindergarten now all the way up to university. They've built the schools, they've staffed them, and they successfully get all their students in there and actually give them a robust education, which a lot of Egyptians are gravitating towards because government facilities are just not doing what they actually need. Safaricom has long been a feature in the portfolio and a mainstay in the African continent as far as investment is concerned. And just when you think a lot of what they have to offer has actually been rolled out, they successfully won the bid to run a telco license in Ethiopia, a close by neighbor of Kenya. So they will be rolling that out from 2022. Ethiopia's got a population of 100 million people versus Kenya's 44 million people. And if you look at the success that Safaricom has had being the market leader in Kenya with more than 80% market share on 44 million people, you can sort of have an idea of what they can do rolling out voice, data, and so many other things when they get into a country that's 2.5 times that size. We also have companies like Helios Towers and Zenith Bank, which is in Nigeria, and we maintain some exposure to sentiment for insurance. We do worry about inflation, and we think gold is probably a good way to sort of protect against that. We have some in the portfolio for as and when that might actually take off. But of course, that's not to say that there aren't threats that are plaguing the environment at any point in time. Of course, there are many things to consider, and I think chief among those is the fact that when will economies be running at optimal once again? When will they be open to allow business to conduct as well as possible? So the vaccine rollout and hopefully the end of the third, fourth, fifth waves will determine to a large part how that actually plays out. Indeed for Africa, but also the same for many emerging markets. And terrorism continues to be an issue to grapple with. There are communities that feel that they're excluded from the wealth and the riches of their nations. And while that exists, they're actually going to find different ways to sort of have their voices heard, which is also not a good thing. Government's finances are not in the greatest positions, though of course the recent announcement about the IMF SDRs coming into many of the countries in the world is welcome relief, but that just means that the counter-cyclical support that one might need does not really exist in many of the economies. And I think rising inflation or potentially rising inflation has been a theme in many of the discussions beforehand. Africa is not immune in that respect. So those are some of the things that we need to watch out for. So why do we think boxing is probably a reasonable analogy for how one actually goes into investments? It's really about setting up a plan and then enacting that plan, making sure we go through how we select the stocks, how we put them into the portfolio, and how we manage the portfolio on behalf of our clients, and still managing to roll out that process despite the headwinds that we might face or the surprises that we might face from time to time. And I think Mike Tyson had some choice words with respect to the similarities or to what happens to a lot of people when the plan actually comes across some challenges. So we think Africa is particularly attractive. Rudy Arias has been doing it for a very long time, and we continue to focus on the African continent, and we think there's some great investment opportunities, particularly for South African domiciled investors who currently have a strong rand and can go out shopping at relatively low prices. Thank you very much.
Thank you, Fungai. Straight over to Paul.
Good afternoon, ladies and gentlemen. I'm Paul Neethling from Coronation's Global Emerging Markets team, and thank you for the opportunity. So my title today is Emerging Markets in the Year of the Ox. And the reason we chose this title is because China is the biggest constituent of the Emerging Markets Index at around 37% of the index. So it's an important market to get correct and to choose the stocks correctly in. So I decided to show you in this presentation sort of two key things. The one is China's handling of COVID-19, and the second one is an interesting stock idea that we have found, not recently, but we have increased the position in recently. So to kick off with, I thought let's just start with a thought experiment. In a pond, there is a patch of lily pads that doubles in size every day. If it takes 48 days for the patch to entirely cover the pond, how long would it take to cover half the pond? So this is from the book Thinking Fast and Slow by Dan Kahneman, and we'll get back to the answer a little later. Okay, so on to China's handling of COVID-19. So despite COVID-19 originating in China, as all of us know, China has handled the pandemic extremely well. So yes, there are always question marks around data coming out of China, whether we can believe it, whether we can't. I think what's key in this chart to show you is, first of all, notice the chart. So it's daily confirmed, new confirmed cases per million people. But notice that the chart is, I had to do it in log form. So not a typical linear chart, just because China is way at the bottom. So if I did it in linear, you'd hardly see China. It's literally 10,000 times better than anyone else. So my first point is that, like, I think it's highly unlikely that you can underreport by 10,000 times. And then this is also corroborated by, as an example, last week or the week before, Trip.com, which is like China's Expedia, reported results. And in China, local, so domestic flights and accommodation is up on 2019 levels. So that's pre-COVID. So I think it's corroborated by that China has just handled this pandemic exceptionally well. The next slide shows that so far, it hasn't been due to an exceptional vaccine program. So basically, you look at this chart, it shows you vaccine doses administered per 100 people. You can see Israel way at the top there. Not far from Israel is the United States and the UK, two big economies that have done really well. And then toward the bottom, company with Brazil, Mexico is China. One important point to make is on this chart is that when China decides to do something, they really do it exceptionally well. So as an example of this, last Friday, China vaccinated 14 million people in one day. That is more than 50% of the global vaccines administered on that day. So when we heard about COVID in China, we had one colleague look at COVID the majority of his time. He spoke to the best people in the world. And we think that China handled the pandemic mainly because of these reasons. Handled the pandemic so well, mainly because of these reasons. So they had the learning from SARS along with the other Asian countries who experienced SARS in the early 2000s. Exceptional coordination and leadership. So as an example of this, in Wuhan, China built a hospital, a 1,000-bed hospital in 10 days. That, just to give you some context, Groote Schuur here in Cape Town is just under 900 beds. So China built the equivalent of Groote Schuur in 10 days. China also had a very large respect for the virus, data, and science, which is more than we can say for some of the Western countries. It did take China a while to admit what was going on, but once they realized what was going on and the gravity of the situation, they took the unprecedented step of a hard lockdown of Wuhan, a city of over 11 million people. China also acted in a very cohesive and science-based way, and they have a highly automated contact tracing system. In China, basically, the two main payment apps are owned by the two big internet companies, Alibaba and WeChat. Almost all payments happen digitally with your wallet, so through WePay and Alipay. And within those apps, you have a QR code, and the contact tracing gave you, if you came close to someone with COVID, so your app would go red. And literally outside, we might have seen the photos and videos, outside every block of flats, they either had a policeman or equivalent who would literally check your app. And if it's red, you're not allowed to go out, you've got to stay at home. I mean, that's completely different to something like South Africa, right? Where we also have the contact tracing app from the government, but it's completely voluntary for you to install. So very different in China. And then I suppose lastly, and for us as investors, this is something that I think we can really appreciate, is that for a virus like this, you really need to appreciate the power of compounding. So back to the question earlier on of the lilies doubling in the pond. So it said that it doubles every day, and it takes 48 days for the lilies to cover the entire pond. How many days would it take to cover half the pond? So human beings naturally, would think linearly, which is quite fine, but oftentimes it's not right. So when it comes to a virus or investing, it's not the correct way to approach things. So it would be quite acceptable to have answered 24 in a linear fashion. But in fact, the correct answer is 47 days. It takes 47 days for the lilies to cover half the pond, one extra day because it doubles, and then it's covered the whole pond in 48 days. So onto the stock idea. The stock idea that we have is Tencent Music Entertainment, which is a subsidiary of Tencent Group. So Tencent Music Entertainment, or TME, think about it as sort of the Spotify / Apple Music combined with YouTube Music, combined with Audible of China. TME has 845 million monthly active users. That's more than double of what Spotify has. And Spotify is the biggest DM one. So TME is the owner of the leading audio platforms in China. It has a strong management team, the culture of innovation, and then synergies between its platforms and the social media side of things. So here, just to take you through the platforms, online music, bottom left, that's kind of typical Apple Music / Spotify. Although you can see it has more social elements to it, where you can share songs, comment, etc. Then you have online karaoke, which is where you can record yourself singing along to a song, send it to friends, live share it with friends, or online. Then you have live streaming, which is more sort of professional user-generated content, where you can pay someone or give them a tip to sing a song that you like, something to that equivalent, and you can chat with them, join a group, etc. And then the more recent innovations, long-form audio, that's basically podcasts, or like the Audible equivalent where you can get a book narrated to you, and then online concerts, which they innovated and obviously came very handy during the COVID pandemic. Sorry, last thing on that slide is just TME partners with the big leading developed world music groups, Warner, Sony, and Universal. So TME, in our view, is a compelling growth opportunity. The core business is very under-monetized. So the music paying ratio, which essentially is the number of monthly active users that pay as a percentage of the total monthly active users. At TME, that's only 9% versus 45% at Spotify. And then ARPU, which is average revenue per user, is $1.40 at TME. For Spotify in the US, a user would pay $10 per month. So the $1.40 can be compared to the $10, and then they're only monetizing 9% of their user base versus 45% for Spotify. So you see those two metrics illustrate that TME has significant scope for growth. It also has a whole lot of new growth drivers, as I've touched on. This includes online as well as more recently offline concerts, podcasts, book reading, and then being a Tencent company, advertising growth, which is growing over 100%. And typical Tencent style, so far their monetization of their free users on the advertising side has been very conservative. Not only is it a growth opportunity, but we think it's a profitable growth opportunity. So if you look at this pie chart on the bottom right of the slide, TME has 70% market share. The next biggest one, which is also owned by a big internet company, NetEase Cloud Music, owns 19% of the market, with the balance owned by a few smaller players. So we think it's a rational duopoly between the two big companies. And then also, if you look at the chart in the middle, the top 5 music labels' market share in terms of tracks streamed okay, it's 2017, but it shouldn't be too different today. In the developed world, it's 85%, whereas in China, it's only 30%. So that shows you those are essentially the suppliers into TME, the people providing them with music. The balance, the 70%, is made up of either independent music labels in China, which are very fragmented, or independent musicians going straight to TME. So what that shows you is that your supply base is fragmented, and then you control the market. So we think that that market structure enables you to earn healthy long-term margins over time. TME is also a very strong cash generator because, you know, you as a user, you're paying them up front. So they generate more than 100% of their profits in cash, and therefore they require very little capital to grow. They also have a large cash balance, $3.6 billion on the balance sheet, which is about 14% of the market cap. We think, given the above, revenue and free cash flow can grow easily at sort of 20% and 30% over the medium term. And then on top of all this, we think it's an attractive valuation. TME trades on 3.1 times 2022 enterprise value over sales and a 4.8% free cash flow yield. The 3.1 times EV over sales, it's pretty comparable to Spotify's multiple. But remember, we said that we think TME's margins could be significantly more higher than Spotify's, almost double in our view. And then also the 5% odd free cash flow yield, it's based on earnings in 2022 that are still well below normal. In 2022, those earnings are mostly coming from the social side of things still, and music's only around break even. We are long-term investors. We forecast out 5 to 10 years. And we think in the normal year, music will contribute sort of 90% of TME's earnings. There are regulatory risks. So nothing is simple in life, but we are monitoring these closely, speaking to experts, and we think on a risk-adjusted basis, this is still very attractive. So I think this slide just illustrates nicely how our process works. Archegos was a family office in the US run by an ex-Tiger Cub, Bill Huang, and it was leveraged to the hilt. And when the position started going against it, the investment banks just started dumping stocks to limit their losses. TME happened to be one of those stocks in the portfolio. And there you can see what happened to TME's stock price. But just to illustrate how we do things, we started our TME with about a 0.5% position size. That was in about December 2019. That would have been around the time we did the initiation report. Then as we carried on doing further work, meeting with management in China, Tencent, experts in the field, et cetera, we built conviction to around a 1% position size in June 2020. Then, partly due to the work we had done on COVID, we realized TME would be a beneficiary, and we increased the position size to 2% by September 2020. And then, sort of towards Jan 2021, the 3% position size probably would have been mostly due to market moves. And then as the upside to fair value diminished, we started selling, and we decreased the position size, fortunately, to about a 1.3 position right at the top, just before Archegos hit. Archegos hit and gave us the opportunity as the upside to fair value increased materially. And in our view, the risk-adjusted returns still make a lot of sense. So, we're back at a 3% odd position size. So this slide just reminds you that those of you that have been invested with us for the long term have done well. We have a 3% per annum alpha objective over the long term, which we would think is at least 5 years. Just to remind you on this slide that although we've talked a lot about China today and it's an important part of EM, EM is a diversified market. We have a diversified portfolio of over many different countries. We also have a diversified portfolio over many different sectors. And we also diversify between things like quality, growth, and value. So not taking a macro view, because that's just not how we do things. And I think the other important point to make is with our universe that is so big, we have the opportunity to find all these interesting sort of quality growth companies that we can buy when we think the valuation is right. This is what makes it so fascinating. I leave you with our top 10 today. Thank you very much for the opportunity.
Thank you, Paul. And straight over to you, Yen, in the interest of time.
Good morning, everyone. It's a real privilege to present to you this morning. We haven't got much time, even less now after that delayed start, for intros and pleasantries. I've got about 30 years of investment experience to try and get through in probably just less than 15 minutes now. So I will get stuck in. I'd much prefer, of course, to be there with you all in person, see and chat to you and mingle and answer and ask questions. Although, of course, deep down, I'd really rather be there in July and watching the British and Irish Lions play the world champions in rugby. But anyway, let's get straight to the point. I'm going to answer a few questions that I usually get in prepared remarks now, and then later on, of course, we can get into some interactive stuff. So the first one that I get asked all the time is, when you invest in emerging markets, are you getting a cyclical trade? I'm just going to answer that straight off the bat. The answer is yes, they are still cyclical, but not like they used to be. They're not correlated to the same things they once were. I'll come on to why in a moment, but ask yourself simply, is China a resource importer or an exporter? And then the same for India. I'll touch on the next obvious question. Do you need them if you're in South Africa? And then I'll try and answer the question, is it a structural growth story? And probably more importantly, again, why? I always, as you probably gathered already, like to answer the question, why? The answer, by the way, is simpler than you might think. It's about math, size. And I'll come on to that again later. Now, all of this is why I'm seeing more and more of my North American institutional clients make a permanent allocation to emerging markets and then trade around that. They have a longer term core allocation and then trade plus or minus that with the cycle. This is fairly new. It used to be a binary call. They were either in or they're out. And we'll look at that. We'll look at why that is the case. And I'll try and add some color from what I've seen in the markets along the way. I'll try and challenge some dogmas, because I think, after all, that's what this kind of get-together is about, really, isn't it? I started investing in emerging markets a few years after the MSCI started the EM index. They've changed it a few times since. So in 1988, there were 10 countries that made up 1% of the MSCI All Country World Index. Today, emerging markets in the MSCI account for 10% of world market cap. And there are 26 countries in it. And as you'd imagine, they're very different. And this is how they've changed. Dark green are the original constituents, the light green, what was in there last year. Malaysia and Brazil were the original heavyweights. Meanwhile, Portugal has left us. It was 8.5% at one point. Greece left us for a time as well, but is back now. I don't think that's a good thing, really, is it? And at one point, Malaysia was in both the international developed market indices and emerging markets ones. My point is, they move. They are in transition. The very definition about emerging markets is they are supposed to be developing, moving, not static. This was supposed to happen. MSCI didn't call it the middle income index. And there's a clue in this chart. Malaysia was doing great, but got a little stuck. It happens at all levels, but the middle income trap, as the media like to call it, claims many. Their neighbor, Singapore, went from poorer, one of the poorest countries in Asia in the 1940s, to one of the richest countries in the world, and that's with no natural resources. Meanwhile, China wasn't even in there then. Anyone know why China wasn't there back in 1988? Because there was no stock market in China in 1988. It goes back to the idea of development. Now, this is a well-trodden path. There's a lot of problems with this analysis, and I know it offends many people, but work with the paradigm just for now with me. Because what it is, it's just reinforcing this movement. The country gets the basics right, they open up to investment and trade, and there's rule of law and so on, there's stable currency, then they can start exporting to the richer countries. That's the norm. Capital comes in, ideas come in, and they can export their way out of it. That's if politicians don't get in the way. And if you reinvest, and it helps if you have industries with an ROE, so you have compounding, to refer back to what we were talking about earlier, then you get rising income per person. Then at some point, the wealth effect kicks in, and you have a strong domestic economy as well as just an exporting base. Your companies start to serve domestic customers, and then with scale, they maybe go global later, at the higher end, not just at the lower end. Now, we're all talking about China. China displays many of the characteristics seen in other emerging markets. It's following the same well-trodden path. There's a big difference, of course, and that it's a continental-sized economy. Oh, the other thing about this process of development is usually when the new companies come along and do it, they do it quicker. Germany was quicker than Britain. USA was very rapid. Japan, even quicker again. Singapore, China, now Vietnam. As a country goes through this, it changes dramatically. It gets wealthier. The dynamic changes. Its relationship with the rest of the world changes. And therefore, of course, its correlation with the rest of the world changes. I mentioned that, of course, you can get stuck when I talked about Singapore going from the poorest to the richest. And of course, poor at Argentina. At the beginning of the 20th century, Argentina was richer than Germany. So there are things that can cause problems with this progression. But so far, so good. You can see why the universe changes all the time. Now, here is another thing. When it happens to Malaysia or Portugal, it's no big deal for the rest of the world, is it? It's an option to invest. It's a sideshow. But when it happens to a continental-sized economy, like China or India, that's something else. That moves the world. That's just maths. Okay, time to sort of slay some dogma. China is all about exports. That's what everybody says, isn't it? Then how do you explain this chart? Embracing the market in a typical Chinese gradualist manner from Deng Xiaoping's reforms in the late 70s and early 80s, and then the export drive that followed, was responsible for China's development. But as an economy, China is not all about exports now. How can it be at this size? They'd have to be exporting to Mars. It's actually more domestic even than the USA. And that's a pretty domestic economy. Now, many people think emerging markets is all about this. And I love to talk about things like this too. Shenzhen going from a little fishing village to a city, twice the size of London or something. So what is outstanding, in fact, is the number of Chinese megacities there are now. But this isn't how you make the big money. This is the secret of emerging market investing. This is where you make the money. This is joining up the macro and the micro. This is development economics joining up with a business model, accounting and stock picking. So I'm going to call this country A, but a little secret, it's actually based on the work we did on China. And it has an income distribution in 2010, because as I said, it's a real example, pictured in the dark blue line. Over 2 years, the development of country A, the income per head, goes to the light blue line. That's about 15% growth over 2 years. Pretty good, isn't it? But it's not crazy. What does that mean for your local car company? Its typical first-time customer needs to earn $13,500. At that income level, they're not buying a new Mercedes or an Audi, are they? But they can get a Geely or a Great Wall. Well, the people who can afford it are to the right of that vertical line, the shaded area. And you can see that as the curve moves from the dark blue to the light blue, this increases not by 15%, it basically doubles. That is the potential top line growth. So it's these companies that are operating in that shaded area where you want to be stock picking. And just roughly, this explains why when you talk about Chinese stock picks, you talk about the consumer names, the consumer discretionary names. When you're talking about a poorer emerging market or somewhere like India, then there's probably more staples going on. And this happens all over the economy. And the amazing thing about this is somewhere like China is it's huge. Look at the surge in patents. It's the same for R&D or AI investment or academic papers written. It's just what the UK did, and then Germany and the USA did to the UK, and Japan did, 1970s, East Asia did, and now it's China's turn. So what does this look like writ large? Well, I know you've had a bit of a clue with this one. I don't think you can talk about emerging markets without putting in this chart, can you? I think it's the law somewhere. I know it's a 2,000-year chart and there's a bit of a dodgy scale on there, but I think we know that. We've seen the debate, but it looks pretty, doesn't it? It's only a bit of fun. But you can clearly see in this the peak in the West. So all those darker colors that I've shaded at the bottom, they peak quite a long time ago now. And then you can see the recovery in the likes of India and in more impressively recently in China. So I hear you ask me, I'm in an emerging market or I have a currency that is correlated with emerging markets. I don't need any more in my client portfolios. I get this from my Canadian clients as well. They used to say that in the past as well. But does your domestic market have the returns that look like the emerging market universe these days? Just how correlated are they? Now, I'm not going to get you the regressions out here. We haven't got time. You can do that yourselves or get somebody else to do it. But let's just look at this simple chart. Let's look at South Africa. It looks like it used to be true, didn't it? Like all good cliches, they probably were true once. Maybe this was right. Maybe it was the right dogma for your boss. They look like they're breaking down. In fact, let's look at that chart again without Tencent. Sorry, I mean Naspers. Looks like without that, it broke down even longer ago. So what is different? Emerging markets are not a fixed group. They're called emerging, not middle income. So this is a group that is changing. The index is a snapshot. They are still cyclical, but less so, as the biggest countries today are themselves less cyclical. And some emerging markets are now not correlated with what they used to be correlated, like the US, but correlated with those big other export destinations like China. It's not Thailand and Malaysia exporting their way out anymore. It's China and India and the big domestic giants. Whereas in SA, you have a market that is still very cyclical and dependent on the rest of the world. Plus, now before we look at why EM has changed, let's look at, let's go on and have a look at what else it might mean. So for hundreds of years, the economic and therefore political power was Atlantic-based. In the more recent century, before this one, it was probably based on your relationship with two cities, New York and London, and how people, companies, and capital were connected to these two. But I can't help noticing that the most exciting business models and companies today seem to be based, or at least they were originated in, either the West Coast USA or the East Coast of China. In fact, with respect to China, a strip of land between Shenzhen and Hangzhou in particular. So maybe when we flip the world around this way, we can see that the Pacific century is possibly more advanced and with us than we thought. Now, I normally talk about some big famous tech stock that I love, that I've invested in, for like decades, like Taiwan Semiconductor, which is a great business, a fantastic competitive advantage, tremendous operating metrics, founded by a visionary, and is one of the big four companies in the world that I think you need a view on. The others, by the way, are NVIDIA, ARM, ASML, and TSMC. Because whether you're investing in Apple, Alibaba, Disney, Netflix, the cloud, you need these four companies. But I didn't want to say it was all about this story of scale in emerging markets, because some of these emerging markets are so huge, continental sized, they're going to do to the rest of the world what US companies did. Once they've dominated their own country, initially replacing the local and the foreign competition, then they can go overseas. We see the first doing this now, and more will follow. There will be the Chinese buyers, Daimlers, Coca-Cola's, Apple, IBM, and so on, Indian pharma and software giants and banks and investment houses. It's just economics and maths. This company here is Midea. It does kitchen appliances and air conditioners. It's got rivals like Haier and Gree and similar companies like Robam and Joyoung, and most of them have their headquarters in the same cities. They keep reinvesting this fantastic cash flow to fight the competition. They get more efficient. They get higher and higher levels of profitability. I tell you, I wouldn't want to compete with them. This is the share price chart. It looks like a tech stock. It's a 10-bagger for an air conditioner and kitchen appliance maker. There's lots like that. Some well-known, but there are other great companies in there you might not know yet, quietly taking over the world. So I'm going to conclude because I see I'm running out of time, but there are a different mix of countries compared to the previous decades. This is a snapshot in time of countries that are undergoing massive changes. Some of the countries themselves are developing very rapidly and end up having very different sectors and stocks dominating. So why would they behave the same as they used to? Some are not the cyclical or exporting dependent countries that they used to be. And as a result, some of our clients are changing their approach. Instead of just trading them on or off, they have this long-term strategic allocation and the tactical around it. In fact, some of the biggest investors in emerging markets now are emerging market investors. And this is huge. We've just got a mandate ourselves from a quasi-state emerging market fund. And we know that some of the biggest investors are their own funds now. They need to match their liabilities, their future liabilities. So they need to keep pace with the higher returns of those countries in order to match what their pensioners are going to need. And this changes everything. It changes the governance standards. It changes the wealth. It changes the correlations. It changes the risks. And it changes the opportunities. So thank you very much. And I'm going to stop there so we can try and keep to our schedule.
Thank you, Ian. And thank you to Fungai and Paul. I'll keep the questions over for the breakaway room. Please join us in the breakaway room on EM later. Over to you, Ian.
Many thanks, Pierre, Fungai, Paul, and Ian. Always very insightful. We're a little bit behind time, and like Pierre said, we're going to carry the questions over to the chat room. But keep those questions going, and we'll be sure to answer them a little bit later. Our next topic is passive investing, and here to introduce the panel is Dion Jansen van Rensburg. Dion, thank you very much for joining us as well. Dion, you also a Cat2 DFM business where you create local and global solutions, and you screen most of the world with the active managers that we've seen as far, but also the non-active space and funds there. It's going to be an interesting topic, and I know you also blend some of these active and passive managers in some of your solutions. So looking forward to your panel, introduction to your panel, and the floor is yours. Thank you.
Thank you, Eugene, for that introduction. So passive investments achieve exponential growth in recent years due to the low cost and performance of these funds. But the term passive can be confused for doing nothing. However, there's an active decision to select the appropriate passive or index fund in this ever-growing universe of funds. So today in our panel, our first speaker is Gareth Stobie from CoreShares that will discuss multi-asset index funds. And he will be followed by Nico Katsko from Satrix that will discuss the nuances of index investing. And lastly, we have David Swanwick from Dimensional that will discuss smart beta or factor investing. Just a reminder to please post questions in the Q&A box at the bottom. And if we don't get to those questions, we'll answer it in the breakaway room. So I would like to hand it over to Gareth.
Morning, thank you, Diane. Let me pull my slides up here. Is that working?
Gareth, we can see your slides, but I think you might be trying to get to slide 1. There we go. Cool.
Great. Super. Well, nice to be here, even if it's virtually. And I'll kick off straight away so that I leave time for everyone else as well. I guess how I wanted to frame the benefits of passive or indexing is within the context of the financial planning world and trying to help clients meet their particular financial goal. Because at the end of the day, the process of financial advice from a needs-based analysis point of view is to help a client reach their particular goal, their particular savings outcome. And what I'm going to try and demonstrate here is how effectively indexing can be used in order to meet that goal, meet that outcome with the highest level of predictability. So if you're trying to build a solution, trying to meet this outcome or this goal, there are really kind of 2 bits of information that you're dealing with. There are a number of what we would call uncontrollable or speculative parts of the equation. And one need only look at the turmoil of the world over the last sort of 24 months, whether it's geopolitical turmoil with Trump's departure and his leadership over that time, or obviously COVID, the market correction, and then the market recovery, and some of the individual company events over the last while. Take Sasol's crash and then recovery as well, to demonstrate that to call markets, asset classes, companies, interest rates over the nearer term is incredibly difficult to do. Some people might get it right, and you might get a call right, but to consistently do that is very, very difficult to do. So when looking at kind of the board of what you can work with, there are a number of uncontrollable or speculative aspects that we would want to, as a firm, sort of park to one side and say, well, there's only so much you can do with that. Then there are the controllable aspects of investing, aspects that are deeply supported by research, that have this body of evidence behind them, that are repeatable. And because they're repeatable and because there's so much structure around them, you can use these pieces of evidence in a sort of more controllable way. So what are the controllable parts of putting a client solution together? I'm going to hone in on 4 today. There are a number of others, but let me talk about some of the 4 key ones. And as I go through it, you'll soon start to see how indexing starts to play a very important role in it. Because once you accept that those uncontrollable speculative parts are very hard to get right on a repeated basis, one can move over to this controllable and evidence-based environment that has more consistency to it. So I'm going to look at the 4 key levers of the sort of controllable environment, and that's asset class returns, strategic asset allocation, diversification, and cost. 4 controllable levers. Lever number 1, asset class returns through time. I mean, we often talk about these different asset classes with a fair degree of confidence, because that confidence stems from decades of observation and decades of experience in appreciating how different asset classes behave through time, what your expected return should be from those asset classes, how they are correlated to one another, and so forth. And we often cite a database called the DMS database, which stands for Dimson, Staunton, and Marsh, who are a bunch of academics from London Business School. And they have mapped global markets not over the last 20 years, but over the last 120 years. And from that long body of history, you can pull out returns and return profiles and correlations from the different asset classes. And you can then start to put those asset classes together in a multi-asset framework, in a strategic framework that makes sense for trying to achieve a particular outcome. And let's benchmark our outcome relative to CPI, for instance. We know that over the longer term, you should expect a significant return premium to inflation through time by having your money in the equity markets relative to cash and bonds, for instance, what these gentlemen called the triumph of the optimists. So whilst it feels uncomfortable for clients at times to have a high equity allocation, we know that, for instance, equity drives longer term returns above inflation, whilst other asset classes are more defensive and have other correlation benefits. So one can take these asset classes and put a portfolio together that structurally or systematically helps build a client outcome relative to, say, a CPI benchmark that has got backed up by decades of data. So that's how one builds this sort of this framework of strategic asset allocation. But hang on, I mean, managers are often saying, yes, but we can, trade depending on how we see the market, and we can take bets on certain currencies or certain asset classes and tactically provide returns that are better off than just simply having a strategic framework. Well, research that we have done actually suggests that most managers, in terms of their tactical asset allocations around their strategic benchmark, don't add enormous value through time. Yes, you might get points in time where they add enormous value, and you might have an outlier event where the manager got it particularly right. But if you look at rolling returns, and we looked at it over a 15-year period, more often than not, managers have actually detracted from their long-term strategic asset allocation by making tactical asset allocation calls. From a client standpoint, looking at rolling periods of returns, the manager would have been better off being in a strategic asset allocation framework. 48.18% consistency relative to the benchmark versus only 32%. And that's because these tactical asset allocations are often made around some of those speculative, difficult to control inputs. The third lever that one can pull, particularly in today's modern age of indices, is that of diversification. The South African benchmark, kind of the most spoken about one, the top 40, for instance, is often criticized, for example, because of concentration issues that it has within its index. And that's fair criticism, because probably 8 to 9 stocks of the 40 stocks statistically drive the return of the top 40. You might as well not be invested in the other 30 odd. However, in today's world of indices, you are able to build new indexes that take into account more prudent diversification, better portfolio construction from a risk-based point of view, and give you exposure to well-rewarded, well-researched area of actually active management, and that's the world of factor investing. So quality shares, value shares, momentum shares, and so forth. And here we see the difference between a top 40 index, which has been a very good investment and been difficult to beat for a large part of the active market, but also the merits of smart beta or some of the other indices that are available that help to diversify the portfolio, add additional stocks to the portfolio, and add additional return drivers to the portfolio. And this type of smart beta approach or factor approach is available in index design. And then lastly, cost. Again, some research that we did over the same period in the low equity category or CISA category showed that actually funds that had low total expense ratios had far higher consistency in terms of outperforming their CPI benchmark than funds that had expensive total expense ratio. And Morningstar, for instance, is cited as saying that both globally and in South Africa, if you sort of closed your eyes and picked funds based on just one criteria, cost is probably the most important criteria to hone in on. So having a lower cost within a fund provides this sort of structural head start to a fund's return. And this consistency of outperformance of the benchmark is in part caused by lower costs versus higher costs. I'm now going to reverse a bit and just flick through the 4 points and show how indices play a role. So strategically, we can allocate to the different asset classes through a low-cost index format, strategically, mechanically, do that in a sort of systematic way to achieve the client outcome. There isn't a lot of benefit of tactical asset allocation around that outcome. You may or may not get it right. You may or may not call COVID or Trump's success at the elections and so forth. Today's indices provide not just concentrated market cap indices, but also highly diversified indices that give you exposure to well-rewarded factors through time. And lastly, you are able to keep costs very low within the solution. Over the last 12 months, CoreShares has been working with the Efficient Group and BCI and their multi-manager team in their select range, and they have launched 2 new multi-asset funds, a high equity fund and a low equity fund. The high equity fund has got 78% allocation to risk assets, so property, global equity, local equity, for instance, whilst the low equity fund has got a 43% allocation to risk assets. Because they are implemented primarily passively, one can keep the cost low with a total expense ratio of only 47 basis points. And these funds have been designed in a systematic way in order to achieve the highest level of predictability relative to the benchmark and to achieve the best possible outcome for clients using the strategic asset allocation, using the best-in-class indices, both market cap weighted type indices, but also allocation to mid-cap stocks and multi-factor type shares. And we would say that this is the new generation of multi-asset funds and how it can be approached through absolutely through a passive framework with very little active management or tactical asset allocation overlay. Thank you.
Thank you, Gareth. Next up is Niku from Satrix.
Good afternoon. I'm Niku Katske, Head of Portfolio Solutions at Satrix. I'm delighted to be discussing the topic of passive investments and hopefully provide a fresh perspective on why passive funds in South Africa are not all that passive. I want to start off by showing a somewhat provocative quote by Professor Daniel Polikow, which argues that the choice of benchmark is the single most important investment decision made in the long-only active investment space in South Africa. In fact, Professor Polikow argues that this decision dwarfs nearly all other value-adding decisions made in active stock selection. Now, thinking about this statement in light of the general low levels of active risk taken by long-only active managers and the distinct nature of our concentrated local benchmark indices, the statement does not seem that strange as it does at first sight. So my hope is to unpack this statement into why the choice of what we track matters so much in the local investment space by focusing on how our benchmark indices are anything but passive. So let's start by discussing what we understand by the term passive. Now, the term tricks us into believing that passive investments are style agnostic strategies with the sole aim of replicating an index and minimizing cost. Yet passive indices in South Africa in reality have strong active tilts, which make labeling index trackers as passive a misnomer. Now, while passive or index tracker vehicles are indeed bound by construction rules, active managers in theory should preserve the ability to tilt toward the factors that are currently in favor. In reality, though, we see active managers often remaining style neutral to the benchmarks they track, so failing to tilt consistently and successfully, which ultimately negates the ability to add value after fees. Now, this provides managers willing to take active tilts with a great opportunity to differentiate themselves. For this presentation, I want to elaborate on 3 features of the local active-passive debate that tie back in to the main aim of this presentation, and that's showing that index trackers are anything but passive. So and the 3 things that I want to show is that active managers seldomly outperform index trackers, outperforming consistently is a rarity, and then thirdly, and what I really want to focus on, is showing that index trackers have active risk resembling active funds and often consistent and strong style tilts. Now, to show the difficulty that active managers have in outperforming two of the most popular index trackers, the capped SWIX and the ALSI, we show the rolling 3-year performance of the ASISA SA General Equity Retail Fund class relative to these index trackers. Now, for this plot, we removed tracker and style funds from the active list and added a 50 basis point fee per annum to the index tracking fund compared. Now, this means that the zero line that you see there represents the rolling 3-year index returns. From this, we note that the median active manager locally has struggled to outperform the index over the past 2 decades. In fact, for both the capped SWIX and the ALSI, the index tracker performance is most often representative of a top quartile fund manager. Of course, with active funds able to invest up to 30% offshore, the overweight SAN capped SWIX index has underperformed active managers in recent years, with much of this underperformance arguably attributable to strong offshore performance. In fact, as we'll see later, the aggregate rand actively invested in South Africa has a neutral style tilt compared to the capped SWIX. If we now look at the ALSI index, though, the median actively rand invested very rarely manages to deliver outperformance, with the index tracker that is more exposed to offshore inward listed stocks consistently performing in the top quartile for the past 5 years. To put now, if you look at that, the orange line, that's the top quartile fund managers, and as you can see, generally the all share index sort of outperformed the top quartile performers of the last 5 years. Now, to put this feat of index performance into context, we also need to debunk the myth that simply identifying these top quartile performers locally should be the winning strategy, which seems like an obvious conclusion. Now, this figure shows what perfect consistency in performance would look like, with a stacked ranking of funds representing a given year's performance, while the color indicates the past year's performance rank. So if winners remained winners, the plot would show green at the top, as you can see there, and it would show red at the bottom, as you can see there. Also, above each of those bars, you would see the rank sum correlation, so which in theory would be 100% if performance was perfectly persistent. So as Bradley Anthony pointed out earlier, in theory, practice should resemble theory, but in practice, it doesn't. So let's show what this looks like in practice. In practice, we see, while 2020 showed some persistence in performance, with green lines generally focused at the top and red lines focused at the bottom, indicating, in other words, that 2019's winners, by and large, performed well on a comparative basis in 2020. This can be regarded more as an exception rather than the rule. So if you look at the past 5 years, your active rand invested would have been better off picking the past year's losers and then investing in those. Although omitted here for brevity, looking at the same numbers on a 3-year basis produces even worse performance numbers for active managers. Now, for the remainder, I would like to unpack why passives are anything but passive. So first, again, consider the ASISA General Equity Fund class with tracker and style funds removed. On this plot, we display the 2-year tracking error and relative performance compared to the capped SWIX. Now, from this, we see that active funds generally exhibit the tracking error of between 3 and 8%. If we now add common index trackers to this mix, it is striking to note that many of the passive alternatives closely resemble active fund tracking errors relative to the capped SWIX. In fact, compared to the capped SWIX, the ALSI that you can see there in the middle, the ALSI Top 40 has active risk higher than the median active manager in our market. Now, this crudely shows just how active index trackers can be when compared amongst themselves. And of course, if you look at the sector indices, they resemble active risk that very few active managers would be willing to stomach. Now, to get a clearer sense of what the above means on a practical basis, we look at it from a holdings perspective, specifically to get a better sense of just how active index trackers can be in terms of their style tilts. Now, before we delve into quantifying passive style tilts, let's briefly discuss the evolution of breaking down returns into style components. Now, without going into too much detail, it is well known that since the 1990s, outperformance of the benchmark, traditionally referred to simply as alpha, has become a more nuanced definition. In fact, if one accounts for systematic style components that explains excess returns through time, the scarce resource that is alpha shrinks even more. So while there is a well-documented zoo of factors out there, the academic literature has shown that certain company and sector features, such as company size, cheap valuations, balance sheet quality and profitability, as well as several other behavioral traits, such as price momentum and stability of returns, are all strongly correlated with future excess return sources. Now, strategically accounting for these systematic and investable features should, in theory, help active managers beat their respective benchmarks. We show that in the next few slides, that active managers on aggregate fail to differentiate themselves sufficiently on a style basis, particularly in the local setting relative to the capped SWICs. Now, on this slide, we show that active managers quarterly style tilts from a holding perspective of the last decade. To arrive at these numbers, we collated a database of holdings of the largest 100 active funds currently trading in the ASISA General Equity Fund space, and built a quarterly holdings file time series for each of these funds. So the top and bottom active quintile tilts are represented by the green line that you see there. The dark blue dots represent the capped SWICs, while the light blue dots show the equal weighted tilts, which I include purely to illustrate the information agnostic alternative to either active or passive. Now, we then collate the factor Z scores for the top 100 stocks listed on the JSE at each quarter's end, which allows us to do an attribution of fund holdings normalized to the all share index. So that means that in this figure, we look at the annual average size tilts of active managers with the zero line representing the all share index tilt. So in other words, the zero line doesn't imply there's no tilt to size. It just implies that's the all share index tilt. Now, this figure shows that active managers have a consistent small size tilt compared to the all share index, which stands to reason, while the capped SWICs capping also implies a small size tilt is successfully ensured. The equal weighted alternative, I rescale to 20% simply because it shows very significant size tilt. And again, that stands to reason. For other factors, above the line will always imply better tilt to the all share index and vice versa. So when adding the time series of the different factor tilts over time, and each line there represents the average quarterly tilts to the different factors, we see a few interesting features emerge. First, the all share index by construction has a very consistent and highly active tilt against certain factors, so notably to size and value, and positive tilts towards certain factors like momentum and low volatility. So this follows as companies in favor during a quarter would experience relative price increases, thereby seeing the all share index consistently tilted to larger, more expensive companies with positive momentum. Now, the last 5 years have also seen the all share index tilting towards safer stocks, as investors have generally rewarded safer stocks in sectors, all things equal. Now, what is most interesting, though, is how the capped SWICs index, the dark blue line that you see there, consistently tilts in the mid-range of active managers, suggesting managers prefer taking comparatively small style tilts on aggregate relative to the capped SWICs index. In fact, if we aggregate these quarterly tilts over the past 5 years, this becomes more clear on the next slide. So here we show the aggregate active manager factor tilts as the colored bars, with the capped SWICs and equal weighted alternatives shown as the gray dots. Now notice how the aggregate actively invested rand in South Africa very closely resembled the capped SWICs in terms of its local style tilts. Now this serves to explain why active managers have struggled to outperform the all share index, as it has tilted away from the losing factors, so that's value and small size, while tilting very strongly and consistently towards the most rewarded style, which is momentum. It would also help to explain why active managers have been able to outperform the capped SWICs on aggregate over the past 5 years, as their aggregate style neutrality locally was positively offset by their ability to hold some part of their portfolio offshore. Now, if we look at the most recent style tilt, so this is at the end of April, we see that the largest 100 active managers are again taking an aggregate neutral position on momentum, as you can see there in the second bar, relative to both the capped SWICs and the Aussie. So it seems like no one is taking a style tilt towards momentum at present, while active managers are tilting positively to both value and quality. Once again, the aggregate rand invested actively closely resembles the capped SWICs in its style tilt compared to the all share index. Now, this is likely partly a function of capacity in the market, more closely resembling what is listed on Straight, suggesting that larger managers are either style neutral by choice or by design. Now, if this is indeed by design, then differentiation might need to happen through utilizing offshore capacity, implying local manager alpha might be more a function of rand strength and global trends than local fundamentals going forward, which I find to be a fascinating feature of our local market. So in summary, we highlighted three features of our local market that stands out. First, passive index trackers are really hard to beat, with alpha availability arguably a function of global factors. Second, active managers are often inconsistent in their efforts to do so. And then third, passive investment vehicles have strong and predictable style tilts, with active managers shown to be favoring the cap swings. In summary then, it does seem that there is some truth to Professor Polakow's assertion that the choice of benchmark matters greatly, even to the extent of dwarfing other active decisions. The importance of this decision applies to investors in active funds, whose managers on aggregate exhibit style tilts in line with the capped SWIX index, and where differentiation through an alternative tracker like the all-share index ETF might deliver good and needed alternative diversification. In a market where active managers have shown a tendency to be style neutral, we also believe that those active managers offering a consistent style tilt to be able to differentiate themselves successfully. It also applies equally to passive investors whose choice of index tracker can be compared to choosing an active fund, if you think back to how active the Aussie top 40 is relative to the cap SWIX. So in conclusion, passive funds are not at all passive, and that is worth remembering. I thank you.
Thank you, Nico, for that presentation. Lastly, we have David from Dimensional. David, if you can switch on your camera and share your screen.
We're getting a message. Here we go. We can start now. Great. Okay, well, thank you very much. And good afternoon, everyone. It's fantastic to be spending this time with you and to carry on the very thought-provoking work of my fellow panelists, Gareth and Nico, in their work, this segment on passive investing, primarily by sharing some ideas that underpin the idea of redefining investing, and through the lens that we'd like to bring to that through Dimensional and through our partners in South Africa, Colourfield. And rather than start in any way that's at all technical, what I'd like to do is really just begin with a quote that we often share with people who are looking to do work with us around the world. And it's this one by Thomas Sowell from the Hoover Institution. It's the idea that if you want to help people, you tell them the truth. And if you want to help yourself, you tell them what they want to hear. And I think what's nice about this argument around passive investing, and certainly the way that we work at Dimensional and the principles that we espouse, is that I think people who spend time with us ultimately realize that we're firmly grounded in the top stanza of this quote. And really many of the ideas that underpin this investing approach are also in that space as well, despite the fact that I think we work in an industry sometimes that has spent too much time grounded in the bottom stanza of this particular quote. But I think ultimately what we're trying to do here is create a distinction between traditional and redefined investing. And as you've heard it away from my fellow panelists earlier, the industry has tried to give us this simple dichotomy and binary choice between two fairly obvious alternatives. The first being really conventional investment management, the idea that you can make predictions of the future and that you can position portfolios to take advantage of those predictions. And as we have realized, and I think the debate is pretty much over on this, that involves very high cost. It involves lots of turnover in the portfolio. And as we see time and time again, and you've seen Gareth and you've seen Nico touch on this, the results of active managers across time has not been necessarily what the promise of active management has made out to be. Now, at the other end of the spectrum, of course, we have this idea of indexing or passive management. And it's a really good idea. It's a really good idea in that it tends to produce returns that on average do very well compared to active managers. It allows you to invest in a low cost way with high transparency, and it gives you a good baseline for the start of diversification. But then I think what we'd argue is, and I think there are many who say this now, that ultimately it leaves a lot of return on the table. It leaves opportunities on the table. So as much as it's a great idea in its purest sense, just tracking a benchmark, ultimately what it can mean is that people don't get the returns that they're entitled to because of some of the breakthroughs that have been made in academic finance and in the world of investment management and implementation. And so it leaves us, I think, to think about maybe what that middle space is. You know, what is, do we simply have this binary choice of active and passive, or in fact, is there some other style of investing out there that can make a difference for people? Now, in terms of making a difference, let's think about materiality. And this is a very simple exercise to just show you how important this is in our lives as financial advisors. And as much as I'm presenting to you from the house of an investment manager, I spent more than a decade as a financial advisor myself in Australia before I moved here. And materiality makes a big difference. So what I've done is an exercise to see how small swings make a big difference to terminal values. I've kept it just in pound sterling here, but imagine someone investing at the start of the century and then holding their portfolio for 20 years, actually in just a simple market index, in this case, the MSCI All Country World Index. And holding it for 20 years, a perfectly acceptable period of time to be with a financial advisor as a client. And what do we find? Well, this is like the Rip Van Winkle portfolio. It's a very basic market index. You put all your money in on the 1st of January 2000, and you hold it for the following 20-year period, and your million becomes 2.946 million. This is a great result. You do nothing through that period other than track, and you get that result. But what's the effect of doing a little bit better or a little bit worse? Well, what about 1% better? What about 1% worse on average every year? What about 2% better per annum every year and 2% worse every year? Now what you're starting to see is a huge swing in those terminal values at the 20-year end of the spectrum. And to save you doing the arithmetic, I've done it for you. The difference between earning +1 and -1% per annum over that period is about 1.1 million pounds. 2% better and 2% worse than our benchmark index. Now we're talking about 2.3 million pounds. And if you were here in our forum and as a live audience, I'd be asking you to put your hand in the air, those of you who think 2.3 million pounds is enough to care about. And obviously we know the answer, everybody's hand goes up. So really what instead we need to do is to think about the impact that we're having on clients. And it's exactly the way that we think at Dimensional. We start with the standpoint of investment philosophy. What is it that people are entitled to as a return for putting their money into the capital markets and taking on that risk? And I think it's a fascinating story, and one that ultimately leads to the ultimate investor question. And I think the ultimate investor question is, where do returns come from? And really, when we think about the answer to that question, we have to turn to the academic community, because for 60 years or more, they've been helping us understand the derivation of where returns come from in public markets. And they've answered a lot of that question. And as an investor, you can have a really good experience by taking on board their breakthroughs, exposing your capital to them, and then being disciplined across time with the help of a really great financial advisor. And that's exactly the kind of work that we're looking to do. But really what we should do, and Nico touched on this a little bit by talking about the verified academic breakthroughs that happened across time, is to imagine ourselves as investors, not in 2021, but if we were to get our Doctor Who on and go back through time and imagine ourselves as equity investors before the 1950s. Now, at this time, the summit of thinking is stock selection. Before the 1950s, if you were going to build an equity portfolio, your job was to look at individual companies, run the magnifying glass across them, look at their P&L statements, and then ultimately, having made some decision, your job is simple. Buy as many shares of that company as possible. Believe it or not, it is the summit of thinking at this point in time. And yet we know what happens is that just a short time later, there's a breakthrough as a PhD student at the University of Chicago called Harry Markowitz makes a breakthrough finding in talking about the returns of a portfolio rather than holding individual stocks. In doing so, he says, actually, the return is not wildly different, but the volatility of owning all of them together as a portfolio is actually something that should be interesting to investors because it's so much lower. And in that moment, we really see the birth of the schools of finance. These are the academics who are trying to help us understand the answer to that question of where returns come from. And what ensues is a series of breakthroughs by academic giants who really help us understand this answer in a detailed fashion. In the 1960s, there are academics like Professor Eugene Farmer, Nobel Prize winner of 2013. He's worked with Dimensional since we were founded, and he's often called the father of modern finance. And Professor Farmer takes these returns and these ideas of Markovits and marries them to computing power. And in doing so, helps us understand the answer to two primary questions. The first is, do we actually see a pattern in stock market prices? Now, remember, we are going back to the early 1960s, and it's Farmer who takes this computing power, marries it to stock market data and says, actually, we don't see a pattern in prices. As far as we're concerned, the debate ended there, because ultimately what happens is that information finds its way into prices so quickly that it's very, very difficult for investors, whether they're professional or amateur, to ultimately take advantage of what they perceive as mispricing. That's just a very long-winded way of saying, why do you treat prices as being fair? And it turns out it's excellent, successful investing. The second thing that features this is, here's the market return. It takes computing power to do that. It's actually kind of incredible. The first share is traded on the Dutch Stock Exchange in 1602, but we wait until the mid-1960s at the University of Chicago to finally learn what the market return is. And then what happens, of course, in the 1970s is there's a group of people who take this idea of a market return, and they realize, given the challenges of active management, whether it might be possible to give investors some exposure to this market idea. And so they imagine a world where they can slice off a top of the market and then put some kind of package around it that maybe could be useful for an investor. What we're witnessing here in the early 1970s is the birth of the world's first index funds. It's actually Dimensional's founders, David Booth, Rex Singfield, in conjunction with Mac McQuown, who invented the world's first index funds in the early 1970s. But having done that, they didn't rest on their laurels. Working with the academic community, they realized that just as in other fields of life, like medicine, there would continue to be breakthroughs. And so Dimensional was formed in 1981 as a way of working hand in glove with the academic community and thinking about how to implement the greatest ideas in finance in a way that can be implemented in the real world, in real time, with real money, in a way that produces better than market results without ever having to take on the idiosyncratic risk of active management. And so in the 1980s, we get the breakthrough of the size effect. You heard a little bit about this from Nico before, the term effect in fixed income. In the 1990s, the value breakthrough, one of the most seminal academic papers ever released, the cross-section of market expected stock returns in the 1990s. And then, of course, in the 2000s, breakthroughs around profitability and credit in fixed income, meaning that in the modern era, we can actually, as financial advisors, have conversations with clients that are based around these academic breakthroughs, these verified academic breakthroughs. And instead of treating investing, which is a job where we put other people's money to work in the market in any way that sounds like sport, we can instead have really sophisticated conversations with clients and show them that we are applying their capital to the markets on an evidence-based basis. In other words, we're not left with this binary choice of simple conventional active management or pure passive indexing. Instead, what we can do is we can be liberated from the flaws of both of these approaches, allowing us to rest on the laurels of current market prices, allowing us to understand fair value for securities, but also being able to expect that and capitalize on the idea that there are securities that have differences in returns and have higher expected returns. And therefore, there's something we can do with that through implementation. And really, implementation is one of the most important things because, as our founder, David Booth, says, the research is out there for anybody to access. What makes Dimensional important and what distinguishes us is the way that we implement those ideas. And to give you just the briefest of tastes into what it is that we do around this area, it probably comes down to three areas. The central notion that prices reflect information, and that secondly, not all securities have the same expected returns. There's dimensionality of returns is the way we describe it. And importantly, you can capitalize this. You can harness the power of this dimensionality of returns, and you can implement it in a way in real markets that keeps your costs low, allows you to be hugely diversified, and ultimately end up with a result that helps you beat the market without ever having to outguess it. And that's really what dimensional investing is all about. Now, we break it down to these three simple words of prices, premiums, and process. And they look like this. When we think about prices, let's acknowledge that markets are enormous, and they are not just a place. They're not a venue that people go to buy and sell securities. It's better to think of markets as being an information processing machine. It's almost an organism because of the way that it's able to take the millions and millions of inputs from all of the participants around the world who come together to haggle about the price of an individual security. And we have no greater machinery in our world and no greater technology to understand the value of an individual security than all of the information that's coming together and is aggregated into those prices. So information being in prices is a really central notion, and we don't have better machinery than the markets themselves. They're really, and prices are, and markets are really are the hero of the investing story. And in terms of premiums, we believe that there's dimensionality of premiums and that you could tilt towards certain forces in equity markets that allow you to have a better than simple market benchmark result. Now, I'm going to put some returns up here that should be interesting to some of you because they're South African stock returns as well as returns for ex-South African and emerging market stocks. And we've had presentations that I've seen on this today as well. Now, you should be interested in the light blue bars on the left-hand side relative to the gray bars, which are a simple market benchmark index. Firstly, the idea that do small companies outperform large companies over time? Well, I'm showing you data here for South Africa. Yes, they do. About these other regions, the left-hand bar in light blue, some people call it teal. I don't know what that word is. I'm going to stick with light blue. On the left-hand side, it wins, it wins, it wins. What about a value premium? The idea that stocks with low relative price do better than their high relative price counterparts. Again, what we see is in South Africa, in developed markets outside, in US dollars, in US stocks, and in emerging markets, we see this again. There is a value effect baked into markets. We didn't create it, but it is there for the taking. And I think our implementation is what ultimately helps us capitalize on this. And then, of course, lastly, same story again, with profitability, stocks with high profit tend to beat stocks with low profit over time, again and again and again. And these returns really, when I look at them, suggest to me and should suggest to anyone who's in the business of advising other people, these now become the minimum returns that we should expect for putting our capital into the markets and allowing our clients to take on the risk of having capital exposed to their markets. So no longer do we need to be in a world where we benchmark against active managers. No longer do we need to be in a world where we benchmark against a simple benchmark index, because now actually these dimensions of return, they become our minimum standard, because baked into these ideas and concepts are people who've won the Nobel Prize for their findings and with the rest of the global academic community. And then lastly, we come to this idea of process, and it becomes absolutely critical in thinking about our work here at Dimensional, because you can have the greatest ideas in the world, but if you can't implement them, then it's all for nothing. And ultimately what we find is that implementation really matters a lot, and particularly in an integrated sense. Here's some ideas thinking about just simply trying to approach the capture of the size tilt and the probability of beating our MSCI All Country World Index over 1, 3, and 5 years just by tilting to size, or just by tilting to value, again across 1, 3, and 5 years, or just profitability. If we silo these factors and try and build portfolios that simply attack these different factors individually, the results are going to be okay, but they're not going to be as powerful as an integrated approach. Because ultimately what happens is that when stocks present themselves, they don't present with just simply one characteristic. They are not solely a small company or solely a value company, solely a company with high profitability. They exhibit characteristics of these dimensions differently across time, and an integrated approach is ultimately what allows you to develop this really strong outperformance across time. Now, that's all great, but ultimately, why does this matter? Why should we pay this kind of attention to the academic community? And why should we go to this kind of trouble to try and embrace these different dimensions of return that exist over time? I think ultimately it comes back to this very simple notion, because it makes a material difference for clients. I can tell you that Dimensional's mission in the world is to try to transform the lives of investors and give them a better investment experience. I know that's exactly the same pursuit of our partners in South Africa with Colourfield. And it really comes back to this idea. There is room for everyone in that green space at the top of the slide that you are seeing now. It is there for the taking. And instead, what happens is we see far too many investors on average end up in that orange and red space below where no one needs to be. The minimum standard we should expect for investing in this day and age as a 2021 investor is this idea of exposure to these dimensions of expected return and actually eschewing some of the policies and behaviors of the active management community, because on average what we see is results that don't live up to the promise of active management. It probably all gets summed up for us really neatly in this quote by Robert Merton. He's a winner of the Nobel Prize in 1997. He's one of the 4 Nobel Prize winners who work with dimensional and has across time and is our resident scientist. He says it like this: it's 10% having a good idea and 90% implementing the idea and making it work. Dimensional's been making it work for decades. I very much appreciate the opportunity to be able to spend this time with you. Thank you to Colourfield, thank you to BCI, and to my fellow panelists. I'm looking forward to seeing you in the breakout room and doing some Q&A with you. And with that, I will turn it back over to our hosts. Thank you once again, and great success in the future.
Thank you, David, for that insightful presentation. Unfortunately, we don't have any time for questions. The speakers will be available in the breakaway room to answer your questions. So I'll hand over to Eugene to conclude the session for today.
Many thanks for that, Deon, Gareth, Nico, and David. It's been absolutely thought-provoking. We ended it on a really, really high note, so thank you for that. And a big thanks to all our presenters today and moderators for absolutely fantastic content. Just a reminder very quickly, Dan from Excel Academy posted that Excel Masterclass in the chat room, so if you want to go copy, paste, or download that, or just drop us a mail, we'll send the details through to you. But just keep that in mind and remember to do that. We've also posted the breakaway rooms in the chat room, so you can pick any one of the 4 rooms, click on the link and it will take you to the breakaway room. We will post those links as well in the actual breakaway room, so if you do want to swap from the one to the other, just look at the chat room again. You'll find the links to the other breakaway rooms, but select it before you leave the room, otherwise you leave the conference. And again, from my side, it's been an absolute privilege to host all of you and to seeing you all again. And we'll see you for the main conference again for the 3rd day, tomorrow morning, 9 o'clock sharp. Looking forward to seeing you all there again. Thank you so much.
Hi, everybody who's still here in the main room. If you would like to join a breakaway room, just a reminder to please click on one of the links in the Zoom chat. All the links are there. So click on the link and Zoom should prompt you to leave the main webinar and to join a breakaway room. And once you're in a breakaway room, you can chat with the particular presenter or presenters, and then the links for the other rooms will be in that chat in that room. So you'll be able to bounce between the different rooms. See you tomorrow.